Hello, welcome to the official Singapore market on close summary. Now we've got a busy one today, so let's get straight into the window. First off, we saw a weakening again in the Dubai physical premium, down to 96 cents today. More of the same players really in the window, Trafi and TOTS, so Glencore, mainly the buy side players. Sell side, you've got the likes of Unipec and Exxon. However, we did see the first convergence as Unipec declared an Upper Zakum cargo to Trafi. So that's the first one of the month after 4 sessions. So it's been a relatively slow start. We've got a bit of a variety of players, but the big news this morning is the Aramco OSPs that have just been released. So looking at the breakdown, we have for the European delivery regions, Med and NWE, flat across the board, kept steady. 50-cent cut to all grades to the Gulf Coast, US Gulf, but the Asian numbers are the interesting ones. Now, we have a 120 cut to the Arab Light OSP to Asia. That means it's down to Dubai, and the average of Dubai and Oman plus $1. That's not as much as the structure implied across the full month average of the Dubai structure change last month, which was $1.60, give or take. So what the Saudis have done is clearly they've disregarded the previous method that they had favored occasionally, which was the final week average. So that was around this period of trading, which, as you can see on the Dubai premium chart, is extremely choppy. We had a lot of expiry weirdness, some players coming and going, looking for convergences, avoiding converging. It was a bit of a mess, really. So what they've done really, apparently, is looked at this change from the average of September trading to the average of October trading. That's $1.60, but they haven't done the full cut of that implied cut of 160. They've done 120 for the Arab Light benchmark. So that is kind of in line with what market's expecting, according to the poll we put out on our Twitter account yesterday. It wasn't a full majority, but it was 43%, the biggest amount voting in favor of a $1 to $1.50 cut. The others were kind of spread pretty thin between the various options we gave. So this is kind of in line with market expectations. And you can see that the market isn't particularly kind of perturbed or surprised, upset by these OSPs, because if you look at the Brent Dubai, you have a bit of strength this morning as you open higher here. You can see in the early session here, we have this jump here by about 20 cents, but then we calm down a bit and we're moving sideways basically ever since. So we're up to about minus 60 cents on the M1 Brent Dubai. In terms of Brent flat price, again, the OSPs came out early this morning around this point here. Not really much change immediately, and through the Asian session, kind of a gradual uptrend, but nothing too dramatic. In Europe, when Europe woke up, we had this bit of a sell-off here, but we've bounced back pretty dramatically to back above 64. So ADNOC OSPs came out yesterday. We had weak Upper Zakum. Today, the Saudis have obviously lowered their OSPs to Asia, but not perhaps by as much as the structure implied. And the big question now is really why and what that means in terms of the Chinese and Indian buying of Russian barrels versus Arab Gulf, Middle Eastern barrels. Because we've heard reports that Reliance is looking to sell some of the cargoes it picked up. Remember, we heard they bought nearly 20 Upper Zakum cargoes. They've been very active in the OTC market, and now apparently they're trying to offload those. So we'll keep you updated with that. And also on the OSPs, we're going to do a longer form show later today. So make sure to tune in to get some more detailed analysis on those.
thanks so much for being here and making the move into the actual office. This is the first proper interview from a third party. So
fabulous. Yeah, very, very impressive, I have to say.
Thank you. Well, look, the first thing for me straight away, loved your book, genuinely, not just saying that because, I've got you on the show.
I loved your book too, by the way.
Oh, thank you.
No, I'm not just saying either.
Well, look, the reason why I want to justify it is because when you look for a history in the market, you can go for the world for sale, which is quite a good overview, oil 101. But I think the hardest thing for an entrant is, but what's really going on? It's a bit like an employee coming into a company and saying, okay, I've been given the corporate spiel and I know kind of what we're doing. How does it really work here? You're only going to get that from this book. And you learn the history of, and you can even feel, and certainly, I guess, because I know the market relatively well in the last 10, 15 years, you can kind of feel the tensions, the how people are thinking by the stories, which is like such a great thing to have done. Yeah. And it may seem very niche, but it is a niche market, but that's, if you're in this market, you should want to know the niche stuff. So first of all, honestly, that was great. But I guess that would be the first question for me then, which is like, having explored all these stories again that you obviously knew, but you're going interview sure. and all that kind of stuff. How did you summarize it with Adi about how you kind of see the oil trader mind? You kind of alluded to it a bit about the entrepreneurial mind and this kind of stuff. How would you summarize it now?
Yeah. So Adi and I spent the best part of a year and a half researching. It's a little bit like wallpapering the front room of your house. 90% of the work is in the preparation, and then having done the year and a half of research, he wrote some chapters, I wrote some chapters, and we did it in the space of 4 or 5 weeks, produced what we've produced, and we were trying to put something together that was different to anything else that was out there, and something which memorialized a business which is huge. I mean, it's the largest, least well-known, most remunerative business probably anywhere, and
most niche but most impactful, I would say.
Most impactful is a good description. And we wanted to memorialize that because it hadn't been done. Javier Blatter, a wonderful book, and with Jack Farchi on the World for Sale. Deeds of Daring Do, very much for the general public. You wrote a wonderful, very clearly put together book on derivatives. Liz Bosley's written some books on the physical markets and how they operate, but no one had written this sort of, memorialization of how the business started, who were the people that put it together, where were the places that it happened, and how did this social construct come to be and come to create this massive market we now have. And so in doing that, of course, you analyze very carefully the people who were involved. And what we didn't want to do was to lionize people who had used the market, and benefited hugely from the market, and perhaps have been lionized elsewhere as wonderful traders, which they probably were, but who didn't really add anything to the way the market developed. So, someone like, maybe I'm being unkind, but someone like Andy Hall, for example, lionized as a fabulous trader.
King of oil.
Was a fabulous trader, on a Tuesday night in, the 1980s when the API stats came out and you were long or short a cargo you didn't want. You had to call Andy Hall because he was the guy that would take it off your hands. And he was a wonderful trader, but he didn't really, in my mind anyway, add anything to the way the market,
the infrastructure and
developed. Mark Rich did, on the other hand, created something. So you get people in the book who we think have added something. Jeffrey Sprecher, clearly somebody who, in the way he developed ICE, created something.
If you don't mind me saying, the one person who maybe got shortchanged was Jorge.
Well, actually, that's very interesting. So you on your board have two of the people who I would most admire in the industry. So Jorge was massively influential in the way that the markets developed and the products developed. He came in with a sort of muscularness, really, and did things that other people would not have done, and things that needed to be done and were accepted. The other guy on your board who I, hugely respect is Peter Smith. Peter Smith to me is the ideal trader. Low risk, regular revenue, great mentor, great leader, nice guy, These are
Trading as a business.
trading as a business. So anyway, back to your question after a bit, bit of rambling. What do you need to be a success in this business? Well, I think it's changed somewhat in some ways, but in my mind, the person who is successful needs to be humble, because if you think you're bigger than the market and you know more than the market, you will fail. So you need to have a humility relative to the market. I think no question whether you're a technologically focused or a merchanting focused person, you need to have a mental arithmetical ability. You need to be good and quick with numbers. I think you need to be dispassionate, cool, able to put bad trades behind you and move on. That's very important. And I think you need to be able to really understand your competitive advantage. I think a lot of people don't really understand or seek to understand their competitive advantage, and they end up going down the wrong road, or not focusing on what they are really good at. And then, of course, trading, I think, in the interim, this 50 years has gone from being a single person activity to being a team game. And as with all the folks you've got, you can't just have one man who's at the market interface being the trader. You have to have the salesman, you have to have the analyst, you have to have the structure, you have to have the whole kind of ecosystem, which is now behind trading. And so trading is a team game now, and that's a big difference.
I think the way you were describing that is so interesting, because going back a bit, you were saying that people who've actually innovated and changed the market, I'll go as far as to say that is what you need to be in this business, because I don't know if any other asset class has the same dynamic going on, which is constant reinvention. So, I mean, I can think of a million examples, to be honest with you, but even as a North Sea trader, paper trader, but watching the North Sea physical traders, for a couple of years' time, it will be a major who's the completely driving force behind the market because they have a particular asset that's particularly useful or a particular relationship. So Huan Dong, you talked about, and Shell, he was the first one to form a relationship in China to take 40s, and that changed the way the whole game worked for 2-3 years. And then it got reinvented again. Remember the South Korean arbitrage. You've had now TOTSA with the Midland, they're advantageous. And you're constantly having to figure out, where am I? Where is my competitive advantage? And what is going on in the underlying dynamics of the market to allow me to capitalize? So someone like a paper trader, our advantage way back in the day with Mandara was just looking at the mechanism of how the curve price, as simple as that. But you focus on where you can have advantage and what the market's doing, and you end up, monetizing it and deploying your strategies. But in turn, the market evolves.
Oh, you have to be on the ball, because it's a complex matrix, isn't it, of geography, of products, of product quality, of the temporal aspect.
But what I'm saying is the ultimate capitalism at play. Because then you're making money doing these strategies, the market then evolves and the ecosystem gets more complex and sophisticated, and then you're on to the next one. So every trader has had to do that. They've had to be a business builder, even though they're a trader.
And I think you're right to point out that there are certainly few markets, I would suggest, other than this market, that actually have gone through and are going through that process. Maybe the credit markets would be similar, but I don't think foreign exchange is. I don't think equities is really. I think metals typically is. This is very much unique to the business that that we're in, and to oil in particular.
And I think that goes a way to explain why those markets have been so much quicker to systematize and be so algorithmically driven. Whereas oil, of course, is in Brent and WTI, but it's got a long way to catch up in other markets because of this complexity. I think that answers that.
Yes, I think that there's a degree of complexity there, perhaps, that, again, other than the credit markets with the sort of layers of debt and concepts that they have in that market. There's more in oil than in any of the others for sure. One development, though, that I will not be popular in mentioning it, that I think has added nothing to the course of events, is the introduction and development of speed in markets. I don't see any social or economic usefulness whatsoever to speed.
Of speed of the execution, or
speed of execution. You know, and it's the same thing applies in the equity markets and other parts of the financial services world. You know, speed is self-serving in my view, and you know there are many companies out there and individuals who are making huge amounts of money through the application of technology and speed to dealing. But I just don't see that maybe in a minority of one, I don't know, but I don't see that adds anything whatsoever to social or economic, you know, benefit. And
I've not heard that before, but I can see your logic. I mean, and that's why I guess it's quite orderly still in some markets, like again the North Sea market, where they congregate around the 4 to 4:30 window, and everything's kind of pre-prepared for that time. It is still quite slow. I mean, they do catch waves of, oh, the Brent's moving, so I need to do something. But I guess, yeah, it's still to some.
Someone from XEX will probably come and try and shoot me for saying that. I don't know, but it's you know, it's just it's one of my little hobby horses, and
interesting.
if I was a regulator with a magic wand, I would take away speed from markets.
And how would you do that, do you think?
I have no idea. I think it's virtually impossible. You know, the vested interests are such that it
Well, you'd shorten the windows where you can trade.
I would you know, find some way of outlawing technology that allows, you know, algorithmic trading to happen in a microsecond. You know, for the benefit of the algo trader and no particular good economic or socially useful reason.
Well, I guess that sets up quite nicely. There's the future we've got to talk about, but obviously learning from the past to predict to some extent the future. And the bit I have to talk about because it's so particularly interesting to me is the switch from the banks kind of running the derivatives game with their bilateral trading to the exchange.
Yeah.
And you credit, you know, Jeff Sprecher being a huge part of the whole market because of, you know, what he developed. But again, the reason why I mentioned Jorge at that point is because, you know, maybe I'm wrong here, or maybe I don't know, but it seemed to me that it all came together at once. And I think Jeff in particular played the cards right. You know, for example, okay, we need Platts numbers need to be aggregated in a more succinct way with timestamps. Okay, that needs to be done with technology. Someone needs to take the lead on that. And by Platts aligning with ICE, that was a huge moment on retrospect it sets the governance today. I mean, ICE's integration with Platts, the e-window, the data, it's so intertwined and so entrenched. We are where we are today. And I guess that's why I said the Jorge bit. But having said that, yeah.
You're absolutely right. You know, the Platts have been criticised over the years for very many different things, and ICE too. But you know what they've managed to do together is systemize something in a very complex market.
Yeah.
Which you know required to be systemized, and you know in a certain way they've assisted in the democratization of the market and enabling people to operate in the market with confidence. And I know you were very keen as an individual and as a company on democratizing access to the market, and you know they played a big part, both of them.
The problem now is what you'd expect with any kind of capitalist venture. They've done their job very, very well, and they got remunerated and rewarded. Now the entrenchment is so deep. We are where we are, where you know we see Platts increases 300%. You know, increase on fees year on year. Everyone's complaining about that. You know, ICE have that very strong hold, and it's now getting into legal and regulatory realms, which I personally don't see how it's sustainable, because we've solved the problem, which was visibility, transparency, getting that big boom in volumes, and you know the ecosystem becoming more sophisticated. But now I think it's a threat of we're not able to continue to achieve the things that you highlight so well in your book. You know, if we go back, Morgan Stanley seemed to be in particular very important to some of the birth of some of these new contracts and how to trade, and we could talk a bit about that. But I just wonder if you had any thoughts on why were you so freely able to innovate without restriction? Were people kind of on your side when you had new ideas?
Yeah, you know, that's a very interesting aspect to think about. And you know, there's a story going back to the beginning of Morgan Stanley when Nancy Kropp had come from Sun and John Shapiro from Conoco, brought into Morgan Stanley to start up their business, and they were then asked to take on a very, very bright 27-year-old from within the bank, a guy called Mark Crandall. Mark, of course, subsequently went on and founded Trafigura and had a wonderful career and is a wonderful guy. And Nancy had to explain to Mark, how the rent market worked. So she explained how the rent market worked. And Mark listened, and then he thought a little bit about it, and he said, right, Nancy, now we're going to change that. And in fact, Nancy just retold the story to me a few days ago when I saw her. And that was what he wanted to do, and he was able to do it, and the market was receptive, and Morgan Stanley did it in a similar way that you do it with Onyx, as a client-centric activity first, proprietary second. There were no barriers to doing that. Regulation was light, to say the least, internal permissibility, capital use, all that kind of stuff was a thing of the future. Nobody cared about it at that point. It was easy. Yeah,
but you see what I'm getting at here? So you've got a genius comes along, got this thinker, or these geniuses all thinking about how to make their market work better. And then you get into the second part, which is how do you execute this in an orderly function? And you hand over to third parties the operational running. Those third parties, you create a monster.
Yes, no doubt about it. And that monster is out there, and you're right to recognise that. And how do you change that? How do you further democratise?
Well, that's what I wanted to bring up.
It's harder for you. Maybe the regulatory environment is a little less severe than it was 5, 10, 15 years ago. I think it's probably lighter touch.
Well, I was going to bring you back to the Enron Online part because in this context, because it was really fascinating. I heard different stories about Enron Online, and the way you portrayed it was, this was immediately seen as a threat. So just to give the context, Enron, everyone remembers Enron as obviously this big dodgy enterprise because of the accounting side, but putting that aside, an incredibly innovative trading business,
absolutely,
right? Top talent and all the rest of it. So what their idea was to say, we will be a single dealer type platform, or we will be we'll offer you the liquidity on a screen. This is going back to like 1995 or something like that. Or
99. Yep.
And so a long time ago, this is what we're going to do. And it did launch, right? It did work for a little bit.
Yeah. So it was really championed by a very smart lady who called Louise Kitchen, who subsequently did some other things within the commodities business. Very, very smart person. And she championed this concept of an exchange where the whole world would come to Enron. So it was one to the world rather than, everybody to everybody. And so we kind of thought that really wasn't going to be very good for Morgan Stanley, Goldman Sachs, Shell, BP, and the people who were providing the value in the market.
Yeah.
Liquidity, because liquidity that's the value. So we got together, and the book describes how we got together. And I know it to be true because I was there.
That's what I love. As
Max Boyce used to say, I know, but I know
you're able to get together. That's again emphasizing. Well, you couldn't do that now. People are so worried about collusion and things like that.
Yeah, we did it. It was interesting. There are a lot more little sub stories to be told on that. But basically, Dick Bronx, who was my equivalent at Goldman, JR, and I went out and we persuaded all these people to come and join us. And then, having done that, by complete chance, Jeffrey Sprecher turned up at Morgan Stanley's offices with this technology platform.
Oh, it was genuinely concurrent.
Oh, genuinely concurrent. So he turned up with he cold called, came in, and he saw Neil Shear, who was the boss of commodities at the time. And I always remember Neil coming out of his office and saying, I give that platform a 5 out of 10, but this guy Sprecher, he's a 9 out of 10 at the very least.
Wow.
And that then led to, the combination of the platform, the European oil.
But I'm fascinated, and again, this is the social side, how you're able to convince each other, or one person's able to convince a group, we're not a threat, or we are a threat, or whatever it is. And when I spoke to Dick, actually, this was in the first year of Onyx. We were thinking of making our chairman. Anyway, I was very curious about all this and the Goldman Sachs index. And he said, basically the main pitch from his point of view was the pit trading that's going on, and the locals, which I guess we're the locals now, the market makers, or, Stanley became them on the floor. He said, you're losing so much money a year to them. If it's on the screen, they won't be able to be doing this kind of that. He said that was his major push.
I think we maybe had slightly different objectives, but they weren't mutually exclusive. I think the objective that we had in Morgan Stanley was that, and we had to persuade a number of our senior traders that this was the case. But the objective we had was to increase volume, because we believed that if we increased volume through transparency, we were in a position to be able to do much more than anybody else could with that volume, and would have more opportunity. Now we would cannibalize some of our more opaque over-the-counter businesses doing that, so we had to give something up. But it was
incredibly progressive moves like that. That was like, it's a very impressive thing to have happened. I don't feel that that's possible anymore. I don't know why I say that. Maybe we can explore in a bit. But
you don't have the community, I think, that we had. So the thesis of this book we've written is that it's a social construct, and it's people and it's place, and we all knew each other, and we all kind of got together in different settings at different times, and certainly we competed. There was no element of collusion whatsoever in anything at all. But, people were decent, and people were friendly, and people were, intelligent enough to understand that working together was possible. I think now the objectives of different companies, the size of different companies in different sectors, different focus, different cultures is so disaggregated and so differentiated that it's going to be very hard to replicate what we did.
Yeah, it's a bit like people complain about the EU. You got this big bureaucratic thing. It's so hard to change things, and it's protectionism. I personally see it being more of a newer entrant, I guess, in this story. To that, I'm shocked at how protectionist everyone is. And I mean, this is not even putting the singular blame on anyone. This is every single trading business. This is the brokerage community. This is the exchange community, the PRAs. They like what they've got. They don't want to let it go. But someone, like Morgan Stanley said, we're going to have to give up a bit of this, but we know where the world's going. Let's position ourselves well. I don't see that. And I think it's so obvious that we need a next new evolution, but we are a little bit stuck in this mode. Anyway, you answered it fantastically well. It's the community we lack. And, I've been told myself, it's like, Greg, if you want to do things, you need to make friends. You can't have an enemy with everyone. But I'm like, look, to be honest with you, when I was locked out of this market for 2 years. People wouldn't even show me numbers. I had to fight my way in. So I don't see the community the other way. Like if there's a coming together of minds to be had to create something that works for the benefit of the trading community, I am 100% for it. Yeah. But I don't know why there's such a resistance to it, I guess.
Yeah, well, probably or possibly it's because, whereas in my day it was very much a social construct, and in your day now there's quite an element of it being a technological construct, and there's an anonymity that comes, I think, with
fear, I guess.
A fear and a distance.
Yeah.
That the contiguities of place as part of the social structure.
Colin, where I do massively agree with you, and I think it still exists, is liquidity is the value, and it's not that many players. We're still in a market that's disproportionately influenced by a small number of individuals. You could get the 10 biggest traders in derivatives, let's say, together, and you would still be 80% of the trade. I mean, I know there's algorithms and all that kind of stuff, but it's still hugely influential.
The difference, I think, now from my day was that large element of that liquidity was offered with client centricity behind it. It was helping people understand how to manage their risk at the market interface and providing the liquidity for them to do that. So you were certainly proprietary trading, basis what you were doing with clients, but proprietary trading, certainly in Morgan Stanley, was always secondary to serving the clients. Now, I don't see there are so many folks around who are providing that liquidity today who are doing it to serve clients. I think that element went when the banks were exited from the market by the Federal Reserve in the US, and you guys have come in and you're trying to do that, but there are not too many others, right? Most of the others I see are, they're Andy Halls. They're looking to, make their money. Fine, that's
The market's so developed and sophisticated that you still get a year like 2022 where the need for oil traders is so high in the world. the ecosystem to do it is so well positioned and so high functioning. A lot of money is to be made by staying true to the system and delivering the economic function that is required.
That's the merchanting side.
But I think it all came together, like the derivatives and everything.
Came together.
Great example of like, that's how a mature market keeps something in line. I mean, was it nickel couldn't handle volatility? Oil handled an incredible amount of volatility. Well, I think.
Yeah, I think, and the structures that Jorge and Jeff Sprecher and all of us in our own little small corners have put together over time, developed in a way that the market, became robust and was able to cope with all of these, changes and issues that arose in the market. Coped very well. Some people were very well rewarded for that, so they should be, because they enabled things to happen that made stuff cheaper for people.
Yeah. And back to the Enron Online thing, I just wanted to finish that. So they all came on this one for everyone solution, and then you guys thought, we should benefit from that. We don't like that. It should be a community-based thing, I guess. And then it was the idea to set up a business together. But you were kind of leaning, so it was Jeff's business and he was saying come a part of it, or you kind of all came together at one, or?
So the business belonged to the equity holders, and Vic and I went out and we offered equity to BP and Shell and Total, etc., in return for guarantees of liquidity. So, they got 12, 13%, let's say, which when they finally sold it, they all made $1.5 billion.
Yeah.
So they were the owners, and it was a collection of 5 or 6 or 7 people. And
so how was it sold? Was it IPO?
Jeff was given equity, obviously, as well at the time.
Yeah, but he just IPO'd it, and that's what got
it was, and it went in periods of different offerings. And, the objective of the owners and the folks who had set it up was to get out of it as soon as, we could, because we didn't want it to be our system. We wanted it to be the market's platform. And, there were those who were unhappy at not being included. So Vitol, for example. But Vitol in 1999 were nothing like the force they are now.
It's funny you say that, because when I spoke to a Vitol trader about this, he was saying, well, his version of the story was, we didn't like the idea of it going to the screen because we thought we had an advantage on the pit. Do you think that played a part in it as well? Or?
Maybe at some levels within Vitol, but I think, Ian Taylor, who was running the business at the time, I know he wanted in, and, we didn't let him in.
Oh, wow. Okay.
So, Steve Semmets and Steve Hendel were the same. I can't remember. I think they were called Hetco at the time.
Right.
They wanted in, we didn't let them in.
So, because, I've had this conversation over the years recently, is that why are we not doing this again? Why you've got T+2 settlement, you've got a lot of inefficiencies. I know you say you're not a fan of speed, but you surely are not a fan of inefficiencies and clunky capital and high margining and things like that. Things can be done a lot more efficient. There is another next boom to be done because the technology has been around for a long time. It's just about oil catching up. So why doesn't, if Vitol missed it the first time, come and do it the second time, and all the other companies. And it was interesting because one company said, well, you do know that since 2022, it's actually very awkward to be part of market infrastructure because so much money was made. You want arm's distance. Well, that's the pricing mechanism and whatever else. If you're seen to be part of that, that's actually a bit of people don't want that anymore, whereas they clearly weren't afraid of it.
Well, we thought they might become afraid of it, and that's why we wanted to, hand the thing off as quickly as we could. And I can understand that, there's always going to be that suspicion. It was the same when, in a different context, when we were talking about how to extend Brent, whether to go to, Midland WTR, whether to go to Johan Sverdrup. And one of the reasons that was cited strongly, actually, against using Johan Sverdrup was that it was very dominated by Statoil, and that domination was something that made people suspicious. And it's the same sort of sentiment, isn't it? That you have to have this sense that people trust and they feel that, the platforms and the venues that they use are independent and reliable.
But seem okay to give up the pricing element of that in terms of fees. We'll pay the high fees, fine, but as long as there's that distance and no one else has a competitive advantage. That's clearly the pain point.
Level, it's the level playing field concept, really. So, but I am, I kind of sympathise with you, Greg, really, because I see you trying to do things that clearly would, in my mind anyway, be beneficial to the way in which the market structure was and could develop. And yet it's so difficult. There are so many very, very deeply entrenched interests being hugely rewarded, perhaps in a way that wasn't the case in 1999.
Yeah.
That protectionism, becomes the first thought.
And I do think they've kind of forgotten who put them there and how that works. And that's maybe a separate point. To move on, I would say the very interesting dynamic as well is that, clearly this, and you do mention it quite a few times, this link with Wall Street refiners, Wall Street paper players, and the innovations. It's just the way the beginnings of the banking system as well, right? All kind of made sense. Do you see a similar thing with the emergence of the East? People have been talking about the East growing for a long time, but I see now they're genuinely getting very into paper trading. In China, for example, the exchange volumes are incredible there. India's all these stories about stock options. And, I'm personally seeing that is the area that, if you really think about and you really read your book, you get this sense of very Western. It's a Western operation, but it's growing. Do you agree with me? Do you think it's going that way, more East? And
it certainly seems to be. The center of gravity, I think, moved in the 1970s, early 80s from the US to the UK, Europe, and it's been stuck there for quite some time. And I think you're right. I think the center of gravity is, picking itself up and thinking about moving east. There's a lot happening in China. India has a colossal future in many respects. We're seeing the Middle East become a legitimate trading center, and people and ideas are collecting in that area. So yeah, I think in all probability there's opportunity there that there wasn't. China was always a domestic opportunity in the course of the last 50 years, more than an international opportunity.
Well, this is what I was going to say. To flip it on its head a bit, what I just said, can you really beat the free market thinking of, the Scottish in the North Sea, and then everything becomes, and then London, this hub, and then the same with the US and obviously their innovations, technology, etc. There's this freedom to explore and innovate that I find I don't really get. I've seen these explorations of let's build an exchange in the Middle East, let's do, China's got their exchange, but there's capital controls, and India have capital controls. And it's not, if they embraced what we did, let's say in Europe and US, they would have already had.
Well, it's always been very disappointing, and for many years, the consumer of oil or power didn't have any risk really, because there was a pass-through concept from companies to individuals and etc. And so there was no risk to be managed there, and so there was no need really for markets to let people hedge in the market interface. And to an extent, I suppose, you look at China, you look at India, that they are sort of managed places, aren't they? Managed economies. They're not really places that have the same depth and history of free market thought that we had. Russia was a prime example. I mean, I did a lot in Russia in the early 1990s, as did a lot of my contemporaries, and
because they wanted to have an exchange.
Well, they've wanted lots of different things like that over the years. So they said, and here we are 30 plus years later, and you still can't really trade anything. It's it's been disappointing from an open market trading perspective. So, but I do see movement in that direction, and I think the development of Dubai as a trading center, albeit there's an element of sort of Russian sanctions action there, albeit that's there. Nonetheless, I think there's a sense now that markets are starting to move east a little bit.
But even to make it to current day, I mean, oil on water from Iran has been a thing for 10 years, but now it's Russia, and now there's so much sanctioned oil, and there's two-tiered markets with China and India and Russia, and I thought it would be temporary. The market was pricing it like these things are shocks. It kind of looks like it's materially shifting towards this possibly de-dollarization that's been threatened for so many years, but at least a restructuring or reimagining. And I think that's oil traders always have to keep up with that. I mean, I don't know, but it seems like this year was possibly the most. Usually we like volatility, but to get the Trump style, tariff style, import export style volatility has been carnage, and sanctions, because now you're having to juggle what the physical market is doing versus what the benchmark oil is doing versus, like, it's all these things going on. And then the FOB contracts versus CIF contracts, it's causing mayhem because it's, for example, the propane contracts, you would think US into Asia constantly being sent that way. How does that differential not go down an incredible amount once the US are no longer sending propane there? Well, there was a nuance in the FEI contract, which meant it did the opposite. And you're like, that kind of stuff.
That's opportunity, and that's the sort of opportunity, over the years that people have managed to monetize. And if you can monetize an opportunity by mining someone else's indifference, taking value out of something that your counterpart doesn't care about, then that's always the best way. And sometimes, mining the indifference of the piece of paper that has this particular regulation in it is the way that happens. But
I think that's what makes it so difficult for you. mentioned XTX, the Jane Street. This stuff will drive you crazy because there's no system for it. It can change. You introduce WTI Midland, that changes everything to do with the crude contracts. There's no historical things to analyze.
So you mentioned XTX and Jane Street. That leads on, I suppose, to another thing, which is the element of size. It's such an important aspect these days, having size and deep pockets, and being able to wait until the market does what you've put your positions on to think it's going to do.
I think natural gas has proven that to a big extent, but I think oil still struggles. I think you still hear stories of these big funds struggling to make consistent profits without the physical information. I still think that's an oil unique thing.
That is very true. I completely agree with that. And I think, that's something that won't be solved by AI. That's, that's where you're looking at the, significance of a shrug of a shoulder, or the way someone kind of intones, and things that, you need to find out by being there, knowing that person, face to face.
But the integration of the oil markets into politics, I mean, it's always been a thing, but now you kind of get the sense that there's a lot more active players that have government type information and they're utilizing it. That certainly seems like a new thing for me. But just maybe the final thing to discuss, for yourself being where you are, and particularly, I mean, I found when I wrote my book that it's such a great exercise for self-development, because this stuff, of course, but by going back and making it very clear and concise and creating a narrative, it really empowers you. Empowerment of thought. So given that situation you've now got, I mean, you're not that old, right? You've still got a lot to give in the market. It's not like you have to stop anytime soon. So what would you like to see, given what we've just discussed and given all the challenges going forward? Would you like to see a retrenchment in a way of community, get back to the community sense, or do you think it's unrealistic, or what would you like to see?
I don't think we can go back. I mean, I think we can look back and we can say, look, what lessons can we learn? And, lessons from history are very valuable, as we all know. What can we learn from, this last 50 years? But I don't think we can go back to it. That doesn't really ever seem to me to be a good idea. I think we have to take what we know from there and apply it looking forward. I've told you I would like to see speed eliminated, but that's not going to happen. But I wish it could. I just hope that the social and face-to-face and collegial and contiguities associated with place that have served the market development so well can continue in an age where technology is looking to beat everybody. I think that's a challenge, because technology is easy. People develop the stuff, you sit at the desk, you've got your computer, you don't have to worry about traveling up to the West End for lunch or going over to Los Angeles to meet a client. I just hope that people won't take the easy option, and that they will retain the social structure element.
But it's something you're still doing. It's something you're still interacting with people.
Yeah,
and
absolutely.
I think you've got a big part to play in that. You know, even after this book, it's like a reminder, you know, these things, as much as we love technology and AI, it's not going to solve some of the intricacies. Maybe we do need to be getting around the table a lot more. And maybe that's something you can be helping with.
Well, you know, AI is there to be used. And it's wonderful because it'll make people better traders because it'll give them more information and you know, the use of AI is wonderful, but you know, not I think to rely on it to be the thing that, you know, lazily develops markets. I also think what you're doing is very important. You know, trying to ensure that there is a client centricity, a liquidity provision, a democratization continuing, and that, you know, some of these vested interests and you know, behemoths that are behind the way in which the markets trade are not allowed to completely dominate and monopolize and are challenged. And you know, good on you for being somebody in a company who challenge that.
Well, thank you for saying that. Honestly, thank you for writing the book, because someone needed to. You used the word lionize. It needs to get the reality of what it's like to be in this market, and that conceptualization that's so important. And that this book is what it takes to really be in this market. And you mentioned maths. I would slightly disagree, because I just think you've got AI now, things like that. You've got to have a conceptual brain and maybe an entrepreneurial brain. And I think you emphasize that fantastically well. And there's so much more history to be written. So thanks for everything, and thanks for coming in.
Yeah, no, Greg, thank you. And as I said at the start, I really enjoyed your book as well. And I think hopefully, you know, we've both added something to the canon.
Exactly, and many more to come. Right.
Cheers, thank you.
Hi, welcome back to another episode of Trading Corner. So we're just going to touch upon the market, see where we've moved from last week. Seems like, 5 trading days for like a month recently.
It's definitely felt that way, yes.
Yeah.
Especially coming into the changeover of the month and
Yeah.
all of the physical interests changing and what's been going on with Russia. It's been
Yeah, tiring to say the least.
exhausting.
Okay, so let's start with Brent, I guess.
Yeah.
Last time we spoke, we'd had a lot of short covering, although I think we were suggesting that perhaps not people hadn't 100% covered, given the sanction news that was coming out, a $4 rally in Brent flat price wasn't that aggressive.
Yeah.
Since then, we've softened quite a lot. Interestingly, on the whole curve as well, typically when you hear news like this, what you'd expect is perhaps the back of the curve to normalize a little bit, because it very much is a supply shock in the prompt. But actually all the spreads have given way a little bit. So it's been quite interesting. I think the market still is fairly confused.
Very confused. I was going to say, prior to the Russian news and prior to even our conversation last week, we moved from proper contango on crude spreads to proper backwardation, and now we've kind of settled. The prompt's still a bit backward, but on the future side certainly, and the rest of the curve it's super flat.
Super flat. It's quite interesting. You're totally right. Like before the sanction news came out, there was aggressive, sell side flow. Even the front spread was threatening to hit around flat at one point, and since we bounced back, I think the markets found it hard to believe that the sanction is going to be a long-term or even medium-term issue.
Yeah.
I mean, the way the market's behaving at the very least, you would think that we're pretty good on oil around, and there's no real shortage.
I think so, and I mean you're seeing that with the amount of oil that's on the water, which which is significant, which is keeping a proper bid on freight.
Yeah.
But let's just step back to what we talked about last week with India being the swing barrel, right? Because the rhetoric out of India has been also mixed. Like there's been some chat saying that they're not going to buy barrels, and then there's others that are going to buy barrels, and so it is a bit confusing.
Yeah.
But oil-wise, we have oil.
We have oil.
Yeah.
But, we're coming out of maintenance now.
Correct.
So we should be picking up on these crude purchasing. And that's still, from the looks of it, that has still not happened. I think we still have a lot of refiner buying to come into the market, especially in dated. I mean, if you look at the curve right now, so before the news hit, we were pricing around minus 20 cents on the physical diffs. We have rallied there about 50 cents up to 30 cents, but the whole of the forward curve is really quite depressed. Given a strong backwardated market and the potential of the refiners coming in with the margins where they are and the Russian oil offline, the forward curve looks undervalued 100%. So
the only thing I would challenge to that is that I think the forward curve on a relative basis has been undervalued for a long time. Do you not agree?
Well, yes, for Brent, but actually usually for dated it's the opposite. So typically for dated, our forward curve is always overpriced.
I see, okay.
Because of the forward hedging. And then when it kind of comes to pricing, typically this year at the very least, we've had the roll down. Whereas this time we've got the opposite. And it could be because the refiners are still waiting to potentially get the cheapest barrel that they can possibly do.
Sure.
But typically what we find when they do that is they will all come in at the same time and they won't, it's hard to buy the lowest, even if you have some great foresight. But
they'll be chasing.
It typically
it feels that way.
Creates that environment. So it's hard to really look at dated and say it's a sell. You just have too many supply shock risks, I think, and with the margin where it is. I think the margin is extraordinary. You talk to any refiner, they're the ones that have won this year, right? We've had sustained, very strong margins.
Super strong margins. Just whatever crude is done, product demand is there.
Yeah.
Right, products being absorbed. All the refiner margin hedging, any margin hedging is just getting absorbed daily.
Exactly.
Almost, it feels like.
So it's quite hard to look at the dated curve where it is, with margins where it is,
to be short.
Even regardless of what's going on with the Russian barrels, and if India needs to come and fulfill a short, it's difficult to say that there is downside.
Correct, and also it's interesting. Over the weekend you had the OPEC meeting, and it was quite super non-aggressive tone of increasing supply, which has certainly been their strategy, or certainly been the tone for the last 3-4 months. So everything was in line as expected, and what was interesting was that there was some chat about not potentially increasing supply come Q1 because of the plentiful supply around. Right. So. It's not clear. I'm with you on the margins. Like the margins are strong. We're coming out of maintenance, and you could see refiners coming in to buy crude.
On this curve, they definitely should be doing that. And then also we look at the other regions. TI is doing okay. I think all the stats last week were very, very constructive.
Correct.
So we were having really big crude draws. Let's see what happens with Venezuela, if that is, material in any way really to the crude supply there. And the Dubai curve is back to normal as well. We priced 148 on the front spread today, first day of pricing, very, very strong. And the Brent Dubai is, kind of back to normal levels of like minus $1. So every other region looks okay. It looks like dated is the undervalued curve at the minute as it stands. Now,
sorry, go ahead.
No, I was just going to say the other thing is with freight where it is, the arbs are shut. Every arb is pretty much shut, and so if the demand comes from Europe, which I suspect it will in the next 2 weeks, it's going to be very hard for them to buy Midland, which is
move it over,
but with the freight where it is. Or anything out of Northwest Europe. I think it's going to be very expensive for them to do that, which means the local grades, Brent, 40s, Osberg, Ekofisk, I think they will clear very easily.
Okay. Which
So
is
let's see.
interesting, yeah.
It is interesting.
That
So I
is
just wanted to actually show you this graph really quickly. So I've spoken about it before. I love to look at it. It's essentially the margin, which is, you know, this kind of 3D block line against the GFL.
Mm-hmm.
And it totally makes sense given where we are in the maintenance season that, you know, the GFL is a bit more suppressed.
Yeah.
But I do expect this relationship to start
reverse.
converging a little bit. You know, I think we still will see strong margins.
Yeah.
The reason for that is because the core of the barrel, so gas, to some extent gasoline, but gas oil mainly, is very solid.
Correct.
We're going into high demand season for gas oil, so I think we will probably maintain those cracks there. And so it's the peripheral kind of cracks that's going to move the margin, so the waste products.
Or crude.
Or crude, which
Yeah.
I do suspect that, you know, potentially NAFTA, I mean, this is from a crude perspective, so
Sure.
give me your 2 cents
I'll give you
as
the
well.
product perspective. Yeah.
I do expect that the waste products will probably be the ones to soften the margin rather than the middle of the
lighter,
barrel,
right.
as I was saying, just as we start running rates a bit stronger. And I think crude will start picking up a bit, which will help the margin as well. But I do expect that convergence there.
I think from the product side, it's important to note that a lot of the tightness is coming out of the U.S. You know, heating oil is tight, gasoline in the Atlantic coast, it's tight, it's strong. So there's an enormous amount of U.S. related strength in products, I would say. Tightness exists across the world, but if you look at it on a product specific basis, gas oil, we are, as you said, coming into peak season, but we've priced an enormous amount of that strength already. And as we price it in the turnaround season, it'll be interesting to see whether over the next 6 weeks or so refiners come out to hedge further margins and how that would be absorbed in the product market.
Is the market long gas oil?
It's difficult to say.
Yeah.
I think the market's long gas oil structure.
Yeah.
And it would be, I would find it surprising I would find it surprising to hear if the market was short gas oil, because I think that would be
Also, they've been burnt trying to do that relative value trade all year, right?
all year.
Yeah.
All year. Although I would say that, you know, it could you could see an improvement in balances, and even if you drop a few dollars on the gas oil crack, we're still extremely strong.
Yeah.
Right. So I don't think it's going to
That
weigh.
is the thing, you
It's
know,
just we're still so strong.
Yeah, the difference between margins at $7 and $10, you know, the refiners will still be running 100%.
Absolutely.
So you're totally right. We can give up a few dollars on the margin and nothing should change from an operational perspective.
Correct.
Okay, so it'll be interesting. And also we're coming into Thanksgiving, so potentially local gasoline demand in the US will have that additional support as well. So yeah, I don't see the product demand going anywhere into the year end, personally.
One thing which I wanted to talk about last week, and I actually forgot, but it's super interesting because we're talking about crude structure being relatively flat outside of the front 3 months of the curve, certainly on a futures basis. You know, it's been, you got to remember that it's actually been a very, very long time, probably 4 years, maybe even 5 since COVID, that the market saw deep contango and product spreads, right, across the back of the curve. And if you're a physical trader and you're looking at any available contango, you're probably hedging any storage or pre-hedging any storage requirements. So I think a lot of the product strength can also be driven off just the flows at the back, and what's implied, which is super interesting. So that's actually keeping strength on the prompt margin as well, is the fact that the rest of the curve is offering storage economics for a lot of products that are at levels where physical traders haven't seen that for years.
Yeah.
Right. So it's a flow factor to keep in mind. That's keeping strength at the prompt.
So the guys that, I mean, I'm assuming this contango that they're hedging is Cal 26, or is it further back?
It's not Cal 26 yet. It was 2 weeks ago when we were a lot lower on Brent, you know, near the 60 mark, and crude structure was a bit lower. But yeah, definitely Cal 27.
Cal 27.
Yeah.
So I wonder, they've locked in certain levels. That volume should get exhausted, though. They only have so much storage that they can put this product into.
Correct.
And so if the levels go through there, will they have to stop out and look for better levels, or?
Unlikely. They're probably going to scale. I can't imagine all of that hedging is done.
Okay.
I think it was there for a brief while, and it's already repriced higher. So I think you'll get weight on contango product spreads for a while until the product markets can actually, the demand stops at the prompt, I suppose. You know what I mean?
Yes. Exactly. Yeah. And I don't think we can really go into a truly bearish market until we see these margins low. It's really hard to play, a really short crude view or whatever off margins at $10. Like it's really hard to justify.
I agree, and also if you look at the products independently, as I said, we were looking at them last week. A lot of these products are trading quite independently now, particularly during that short squeeze when everyone was trying to cover short. But even after the market settled down a little bit, if you look at high sulfur fuel, things are pretty tight. I think if you look at and continue to remain tight in Europe and in the US. Asia is actually fairly balanced, I would say, in high sulfur. In VLSFO, we've had a big leg up in VLSFO, mainly probably due to freight, I would imagine.
So are we seeing East-West come off?
In which products?
Like gas oil, like the ones that will be exported out of the East? It's mainly gas oil, I assume.
Yeah, I mean, but there's Eastern strength in gas oil as well.
Okay.
So I think East-West is still negative.
Yeah, something does need to help the freight, right?
Yeah, correct. Yes, exactly.
Yeah, interesting.
And then, so we, the fuel complex still remains tight. Gasoline it's still, I would say, fairly healthy. We've dropped a little bit. Naphtha, we've dropped a little bit, but again, fairly balanced, I would say.
And nothing material to the margin.
Correct, and a lot of fears around Dangote obviously being a large driver of the moves in the gasoline complex, and distillate is strong.
Yeah.
And so where are we going to give way in the margin for it to come off? And so it'll be interesting. I think you'll have to see something change on the product demand side to really, like you said, have a high conviction short on crude, which is, I'm sure you've made this argument well before you and I started talking, and we're going to continue saying the same thing.
Yeah. Okay.
Yeah.
So, I mean, other than that, other than the retracement in, well, I guess across the barrel, but predominantly in crude, it's been a fairly quiet week, I would say. I think volumes have really dropped off. It feels like the market is fairly risk off.
I would say so, yes. Especially with the uncertainty about what's going to happen.
Yeah.
And I think a lot of the product markets actually last week and this week were really driven off crude.
Yeah.
And crude has also, crude volatility's dropped off a little bit.
Crude's dropped off, exactly.
Yeah.
The price action in data is getting a little bit more volatile because the liquidity is not there so much. But we had expiry on Friday, which was fairly constructive. We priced 65 cents roughly on the cash spread, which, given this forward curve at the minute we're seeing on deck barrels, we're pricing in around 30 cents. It was a strong expiry. We also had a lot of Jan EFP transactions. So I think the market does think it is worth owning barrels here with the margins where they are. It's just not come into the forward curve on the dated side yet. So for me, the only trade that makes sense is to go long Novdeck. I think we're going to have, as I said, margin support purchasing from refiners. We're going to, any potential supply disruption, knock-on effects from Russia, like if India come in purchasing, and also all the arbs are shut. So it's going to be really hard for TI to land competitively and fulfill some of the shorts. So I think it's the only thing that makes sense.
Yeah.
Obviously, unless margins get crashed, but I just do not see that happening.
Yeah, I mean, look, last week I said about, I talked about being long general Q1, Q2 product crack rolls, which is fine. I think I like that. But actually, having looked at the curve a little bit more across all products, the deferred margins like Q4 26, Cal 27 margins, those all look obviously significantly cheaper than the front,
Yeah.
as we say, and actually, the front is a little bit of a difficult one. Like you said, is it going to be products that correct down or crude that corrects up? And for me, it actually doesn't surprise me that the back end of the data curve and the crude curve is a bit depressed, because I feel like with all of the rhetoric around the oversupply next year, it feels like it's more of an aggressive prompt roll-up than anything. So if there's buying in the prompt because of margins, as you say, it can just be prompt strength, and then we'll see next month.
Then we price that exactly.
You know what I mean?
Yeah. The only thing that I don't love about it is everyone is short Q1 DFL.
Yeah.
And they're going to have. We saw some stocking out last week with the sanctions. A lot of Jan, Feb buying. People were definitely covering positions there. But I'm very much a contrarian trader, so I don't enjoy getting into the same position as the market. But sometimes you just have to. I mean, it's, especially when it's behaving
sensibly.
Not so much sensibly, as in just numbers do not matter. It's flow, and flow is dominating the curve. People need to enter or exit a position. That's it. They don't care where the value is.
I 100%.
So I think that's very much the scenario we're probably going to remain in.
Over the next 6 weeks or so, into the new year, I would say. I think flow is going to dominate into the new year.
For sure. Okay, well, saying that, I think we know what my trade suggestion is. What's yours?
I actually am going to say that second half 26 cracks. I would say across second half 26 margins buy.
Oh, buy. Okay, cool.
Yeah.
And mine is Northdeck dated. So let's see how we are in a couple of weeks' time. Thank you.
Cheers. Thanks.
Hi everyone. Today I'm joined with Martha Dowding, who is a research analyst and Flux Insight team. And with the Flux News launch, we're going to be doing more and more on weather. So we thought we'd start with an introductory discussion around weather patterns and which specific weather events obviously impact the trading market in particular, some of the historical moves, and then thinking going forward and kind of reviewing the year as well. So Martha, you want to take us away?
Yeah, of course. I think we're going to keep it evergreen today, but just for context, we're coming to the end of the 2025 hurricane season now. And this is a graph of all of the hurricanes that has been in the Atlantic this season. And as you can see, it's been a pretty lucky time to be living in the East Coast of America, bad time to be a fish, and lots of these kind of fish storms. So we have seen lots of the usual hedging from players kind of amount to nothing. So that's being taken off now. So I thought I'd have a look at some of the usual impacts on crude and a couple of products for some specific hurricanes.
It's just butting in straight away, just because gasoline has had a big move, particularly in Europe. And I guess there's a lot of things going on there, but you would expect if you looked at it on a graph and during the time, a hurricane must have kicked off.
Yeah.
Not at all, right? So it's a very
people have such trust in forecasts because of the way that weather works that people start hedging ahead of the hurricane. So it's not like it happens, then all of a sudden there is panic buying, although we have seen that quite a lot. So we do see kind of the build up to it, and especially the later in the season it gets, the more it's kind of like, oh, we're finally going to get a hurricane. We're finally going to get a hurricane. We did kind of see spurs of buying because of that.
Okay. But you have to say kind of a bit uninteresting from a seasonal basis, no?
It's interesting because,
market perspective. Okay, so leading in. So
this is just purely why this is just for me to talk about the weather for a minute. So there was the high pressure center around Bermuda that was a bit lower this year. So as you can see, that means that the path that the hurricane would take from the coast of Africa is going to be more to the east and a bit more north. And there was also a kind of a front of low pressure over the east coast, which kind of disrupted that as well. So that's why we saw this. Like, it was just an incredibly lucky season, I'm sure. Incredibly lucky season.
Okay. So I think we have to say as well, like newcomers, whatever, but we know with hurricanes, it's about what the hurricane impact actually is. So it's always a bit confusing. Is it going to hit infrastructure like a refinery? And then that's kind of bearish crude because they can't buy the crude. It's bullish product because they can't make the product. Or is it taking off storage, or is it going to be demand destruction? That's what's always confused me a hell of a lot. Like, okay, there's a hurricane, but we don't actually know what that really means. So traders are always looking, aren't they, for the path and what?
Yeah, that's exactly what the most important thing is, and that's actually a great lead into the first hurricane we're going to talk about, which is Hurricane Ida. As you can see here, in 2021, that hit exactly where Mars crude in the States gets pulled out of the Gulf of Mexico, Gulf of America, and you can see there's another graph here showing exactly all those offshore drilling had to be evacuated, it got shut in, and as well as seeing the usual effect on the WTI spread, which is kind of a softening of the spreads, as you can see. So usually in hurricanes generally, you do see a softening of the TI spreads because, as we often talk about, WTI has a tendency to kind of pool in place that when they can't export as much, and if there's any damage to kind of infrastructure or refineries, you can see a few examples here and also a little chart of why the spreads do suffer. So as well as seeing that in 2021 with Ida, the impact that the hurricane had on the Mars grade specifically was really clear.
Yeah, very bullish. Which, it obviously makes sense. You can't get access to the Mars crude. It's going to go big. But again, it can be confusing because obviously the weakness in WTI is because it can't export. So you have to get that nuance right, and it's not like a repeatable trade. Just nothing else to say. It's why I don't think people really like trading it, because it's so randomized. But I guess what you can do when the hurricane is forming and when it's becoming closer and closer to impact inland, you can at least look for the momentum trades, right? You can look for what's starting to react and what people are starting to gauge. And I mean, that's a half decent trend following trade. Like you can see it here. I mean, it's rallied 250 all the way to flat. So that's per barrel. So it's quite a lot of entry level to get in and ride that up as that was moving. That's the only thing I can really say there.
Yeah, this was the largest, clearest impact on this specific differential that I saw, but you did see it kind of inching up when you see the path leading into the Gulf of Mexico like that. I think it's quite a niche trade, but it's interesting.
It's a niche trade, but because it's a niche trade, it's very specifically what would impact the market from the Mars terminal going down, obviously the Mars differential. So that's quite nice in a way. Whereas WTI spreads, of course, you've got a lot to contend with. And if it's not a minor hurricane, but it's something that will cause days of damage rather than weeks and months, like, and obviously some of the more extreme scenarios, then you're a bit like, well, you know, am I going to sell WTI spreads maybe on the backdrop of a very strong Cushing market, and there might be a big draw in the EIAs? So again, maybe another thing that probably comes up in the history is, if you can find those niche expressions that are kind of binary, those are the ones to stick to, but it's all about execution, isn't it? So.
Yeah, and I think with the crude differentials in particular, they kind of get up and running a bit faster than getting a refinery up and running as well. Right. So I think that may also lead people to be a bit cautious down to trades like this.
Okay, so Ida hit through Gulf America or whatever, and hit the offshore platform. I remember it myself, 21. It's all, you all hear the whole, right, they're exporting, that they're getting all the people off the Mars platform, evacuation, and that was the clearest thing. But it did reach inland, did it?
Yeah, of course. So this is the path here. We saw it kind of move over Louisiana.
So right in the Gulf Coast, which is where all the major refineries are.
Yeah,
in the US.
so there was refinery issues too. So there was 2 million barrels a day of capacity taken online with some big names there. We've got the Marathon, Garyville, Motiva, Valero. So like these big names you hear a lot in gasoline as well, which we'll get to in a second. But so you can see 60% of the US Gulf Coast production was shut, with 1.7 million offshore crude halted. Yeah,
and again, so it is quite niche, the Mars grade again. But the thing is that the US is very sensitive. The US crude market is very sensitive to the sour grades that they need to blend in, right? So we saw that with the tariffs this year. You block off Canada from exporting their oil sands down into Cushing, and it really screws up the refineries on the East Coast, right? That's what they rely on. And then it actually was very bullish gasoline. Like, there's always knock-on effects. So Mars might seem niche, but actually, you know, it's got to be replaced some way for the Gulf Coast refiners. And who knows, it might have caused like a few knock-on effects. Maybe you don't have that right here, but
it'd be interesting to look into with those heavier grades.
So what about the product side? Because it did hit a refinery, as you said, or it did at least take capacity offline. So it's all about the production there, of which obviously the US export products, but they also export internally, domestically, right, up to New York, which is a big deal.
Yeah, so I think like looking at the New York Harbor, US Gulf Coast differentials for gasoline, that's interesting, but we don't really trade those so much. So I did try and keep it looking at the arb between the US and Europe. So you can see here the graph of when the hurricane hit. We can see that jump in RBOB, which is this green line. It's kind of, I think because it's in September, it's kind of, we're expecting a hurricane to come. And I think there'd just been one a little earlier in the season, a bit less strong. There wasn't the kind of significant jump in prices that I was expecting, but we did see this kind of trend down in the ARB, the gasoline ARB, after the other gasoline the other gasoline focused like little study I did as well. So that must be something that kind of to expect, because that's a fairly significant drop.
Yeah, and again, it's the backdrop of positioning as well. Like I actually put that in my book. It was one of those ones where, you know, you expect refineries offline, bullish gasoline, but if everyone's been expecting it, that is the thing with hurricanes. You do get quite early warnings. You know, it's weeks you can be ready
you can obsess over it.
Yeah. So I think by the time it actually hits and there's the expectation that it's going to get hit, or a high probability it's going to get hit, then you're probably going to have RBOB positioning in there already. So, and if it hasn't really moved up towards that, you're probably getting a lot of sell side resistance. Is that because people are taking profit on the rally? Is that because people don't believe it? Whatever. But it's a very difficult one to be early to, I would say. But the knock-on effects, a lot of the confirmation, you again can maybe get from the more niche trade. So the ARB, again, that's probably a more higher percentage trade, because if it really is cutting off some restricted gasoline, it's probably not a huge deal for the global pool of gasoline, but relative on an export basis, of course, it's going to cause disruption. So a higher percentage trade will always be, in my opinion, like the ARB going up, right? A relative value trade, or down, depending on what we're looking at here. But I think, I don't know, that's kind of my anecdotal point of view on that.
I think people point to it being priced in very easily, and it's the kind of thing with the same thing we see every week with the stats, when people are like, should have gone up and it should have gone down, when it turns into kind of a liquidity trap, and it goes up to such a level that, this is great to hedge at, and then you see it come straight back down.
Or, you know, the thing about sell the rumor, buy the fact type psychology, you know, you see it a lot with the EIA stats. You've got Genscape coming out on Monday who kind of preempt what the EIA is going to say quite accurately with their satellites and whatever. you see the market react or position for a stock draw or whatever, and if it was a hurricane, it's a hurricane. And then when you actually get confirmation of the news, they use that as a liquidity event.
Yeah.
So again, it's difficult in this kind of game because you're always playing that lead lag between the people who have the information right on hand, or have literally been speaking to someone being like, I'm on the Mars platform, I'm getting taken off. Do you have that kind of instant access to that information? Anyway, let's move on because this is that was quite detailed.
Yeah, and this is just more as to why there was not a like huge difference in price, why there was kind of cushioned. You can see stocks were decent. There was no huge power outages, and I think Colonial was off a little, but it wasn't as badly as we'd seen other times. Although that can also be quite unpredictable, the effect that has on gasoline too.
So do we have a hurricane which really caused shockwaves in the market?
Well, yes, we do. This is the Hurricane Harvey from 2017. This went, as you can see, inland, really significant, not a huge path, but pretty powerful. This took more than double the refining capacity online. About 25% of the total US refining capacity was taken online by this.
Wow. Okay, so there, I'm obviously assume, I can't really remember it because 2017 I was definitely trading crude, but I mean, Omar must have been trading gasoline at that point. So what did happen actually? I can't remember.
So let me just check the dates. Yeah, so this is late August. This has a much clearer rally in the both EBOB and RBOB cracks into the end of August here. And then again, it's got sold into, whereas this had less of an impact on the ARB, I think because I'm not too sure why, but I think it did still see that drop afterwards, like I said previously. But I think for this one specifically, with such a huge amount of refineries down and the amount of time it takes for refineries to get back on track, making gasoline of good quality, we did see this really significant rally.
Well, it looks like we had quite a bit of volatility on the ARB as well. So that looks like a choppy one. Again, given its extremity, I imagine there was a lot of aggressive positioning. So yeah, the bigger the hurricane, the bigger the event, the bigger the expectation and positioning and volatility. So that makes it even more tricky, which again, like, you know, I would have said high percentage trade is what I just said before, but it looks like the ARB was as choppy as anything else. So probably quite a tricky one. Be interesting to hear from somebody who's actually trading that, what they think, but I don't remember. So yeah.
Sorry. Yeah, so that's for gasoline. And then for LPG, it's similar with the import-export situation of the States, of it being easy to pool, LST in particular. So this is looking at Harvey again and Laura. So with Laura, the problem with so many of these things is to isolate a cause and effect. There's obviously a million other things happening at the time. So with LST, the LST FEI differential, which is what we usually look at to measure the strength. You can see here, this is taking some of our Flux data and historically. So Hurricane Laura was in 2010, so that's the yellow line. You can see that's seasonal highs, that's all-time highs for the LST FEI contract. But we can say that
2010, what happened, sorry?
2020, it got sold down to from there, which you can say was because of hurricanes. You can also say it's because the Panama Canal was very congested. And there was just a whole series of reasons to start selling this, and also the extremely high prices. But that was a pretty significant drop from Hurricane Laura added to that as well.
Got it, okay.
And Hurricane Harvey, which we just mentioned, that's just a similar thing. We see fractionators down on the coast, which means that you can't export gas specifically in the right, C3, C4 amounts. So we can see pooling of propane in the States as well in the LST, and we can see pressure on the ARB from that.
Okay.
So yeah, you can see that here in late August of 2017.
This is going back to Harvey, yeah?
Yeah, this is the 2017 Hurricane
Harvey. So we were
Harvey.
pretty damn high on the ARB actually, or at least if you compare it to these days, but it came off a cliff, right?
Yeah, huge drop there, yeah.
So in terms of higher percentage trades, then that's also a pretty decent one. I much prefer these export differentials in weather events like this, because it's just, it's temporary, right? It's never going to be like, well, no, I shouldn't say that. It could have huge knock-on effects, and there have been in the past, but generally speaking, you get these flash events, these weather events that can quite consistently, and there's going to be disruption, but you want to isolate exactly where the disruption is, get that highest percentage trade as possible, like we said with the Mars TI. So you've got to look at these things. And actually LST FEI, we got big in propane kind of like 2018, 2019. So this is just before that. This is the kind of thing you would be expecting to have a lot of positioning on, given its kind of predictability. So that was interesting. So that's hurricanes. That's kind of summarized hurricanes. And just, I guess, just to finish off the 2025 part, you do get these indications earlier on in the year that this is going to be a year for hurricanes and that kind of thing. That wasn't that said this year? Yeah, and that's because of the La Nina.
Sea surface temperature, the second highest it's ever been, with the highest last year. I think we're either one or two of the highest at different points of the time. But it just shows that we're all kind of at the mercy of more than one predictable thing. We can see that the surface temperatures are so high, but without the correct path and without the pressure differentials being, in your favor, you're not definitely going to get a hurricane. And I think we're getting
even
better.
If you do, is there going to be a hurricane?
Yeah, so we had really strong hurricanes, but they just were at sea.
Okay, so that was hurricanes. Moving on to, I guess, something quite important these days is heat.
Yeah, so we've been seeing a trend recently of extreme heat in the summer. I think focusing initially on Europe, I think last year was especially hot in 2024. And then prior to that, I think the most significant heat wave was the year before in 2023. I think we got off fairly lightly this year in 2025, but it's still really important to have a look at the kind of effect on the European infrastructure and products, power and gas and electricity, because not only is this part of the market, but this is something that directly impacts, the consumer and everyone watching this. So 2023, looking here, because this was especially hot, we can see the Med refineries were forced to cut up to like a third of their production over the summer. So Macquarie, yeah, thank you. Sorry. Said that heat-related disruption reached about 1 million barrels a day, which is about 10% over the whole year. So this is really, really impactful numbers, and it impacts different refineries in different ways because of the different units, ability to kind of handle the heat. I think when you look at heat and you look at hot weather, the most sensitive would be the FCC, the fluid catalytic crackers, which make gasoline and other, smaller hydrocarbons, and also hydrocrackers, which also produce gasoline. So it's really important to kind of have a look at how these are going to be handling it. Refineries in Europe aren't built to handle the temperatures that, say, refineries in the Middle East are. But even now, I've heard reports that like this year, during the 2024 summer, 2025 summer, they were going to have to cut some of the run productions from in the Middle East, and their whole refinery system is built at a different pressure so that it can handle temperatures up to like 55 degrees, but temperatures are passing that now.
Yeah. I think absolutely topical. I actually remember now, like 2023 was such a basically market move in the products because of refinery fires, refinery overheating, and there being issues in the US as well, right? US and Europe.
Oh, definitely, yeah.
And so given 2023 was quite a difficult year in terms of predicting outright price towards the end, I think it was starting to get a bit more uncertain. I remember coming into 2024, there was an incredible amount of like Q3 buying, basically predicting another heat wave disruption. That was like the leading narrative. And I guess the global warming narrative that you hear all the time, and because it had happened in 2023, people were getting really overhyped for that really early doors. And you just got a massively oversaturated product market in 2024 for the summer, way too early. I remember Bloomberg reporting about record open interest Q1 for this type for these contracts for products. And it didn't materialize. And when it doesn't materialize, everyone's expecting it. And obviously, it's a bit of a bloodbath, or makes the market difficult, if you like. But it is funny like that. Like, even it's almost like anything we do, if things are so expected, they tend not to happen, right? But having said that, the other side of trader psychology is if it doesn't happen, you think, okay, it won't happen, but then it rears its head again. And there's all these things you always forget. Like, if next year there's hurricanes that impact inland, I mean, recency bias, I haven't really, it's been a while since there's been a big impact. So if something happens now, I think there will be a lot of people on the back foot, and it will be a lot of volatility. And I think the same to be said about heat, you could say. Yeah,
it's interesting because looking at kind of the chemical engineering process, it's going to be less efficient. There's going to be optimization issues because the FCCs aren't able to cool themselves as they should because ambient temperatures are higher. That doesn't mean that there's going to be fires. That doesn't mean that there's going to be huge issues, but it just makes it more likely. Same with the hurricanes. Nothing is an inevitability. And I think when people get overconfident, that is how, that happens, how you said.
And this year, there was, as you say, we got off quite lightly in Europe, but there were pockets of this extreme heat. And in particular, the one that stands out from memory was in France, the nuclear power stations, like the water around it, like the river, I guess, or the surrounding water got so hot it couldn't cool down the nuclear reactor. So it really caused some volatility, at least in the electricity markets, power markets. But as you say, like the inclination there is like you have your energy stack in Europe, right? You have nuclear power, you have coal, you have oil, really kind of extreme. But either way, when something goes out, it is an outage nonetheless, and you have to put pressure on other substitutable commodities. So it's always something to be super aware of, even if you're an oil trader and saying, what do I care about nuclear?
Yeah.
It does have an impact, right? Something to be aware of. And as you said, going forward, more and more, this is likely to happen. So.
Yeah, I remember you saying on the podcast last year that people say nuclear is this kind of like magic response to kind of global warming and everything, and people using coal again. But because of the state the world is already in, the cooling facilities aren't really possible, and there's such stringent regulations in Europe that you can't be discharging water at a certain temperature. In France especially, it's really quite low. So I think if we're seeing nuclear build up more, we might have to see a bit of a drop in those regulations.
Interesting.
So looking to the Middle East, we saw a kind of different demand in this summer and also last summer kind of rear its head. We saw a lot more fuel oil demand, so your high sulfur fuel oil.
It's air conditioning story, right? This is now a big theme for the market as well.
And it was definitely like one of those narratives picked up by the media, and we saw bunker demand increase as well. But there was this aircon story that people really latched onto.
Yeah.
So we can see, looking at the graph here, the 2025 seasonal highs, all-time highs in the 3.5 barge crack, which is the Euro high sulfur crack, and it's especially obvious when you look at the east-west. So the difference between the 380 in Singapore and the 3.5 barge crack in Europe, that got to new seasonal lows as well at the end of July because of this like really high demand coming from the Middle East.
Yeah, and just conversely to what we've been saying about hurricanes and the unpredictability, even of heat in Europe, I think the air conditioning story it's a lot more structural, if you like. It is every year. And I think it's almost just something that the countries like Saudi Arabia are very keen to do, right? It just makes sense for them to be exporting less fuel use whilst it's obviously cheaper than crude, and they can play around with the exports and what they're doing. That draw on fuel oil is going to be, I think, something quite staple in the market, and therefore probably quite likely to be priced in quite regularly, a bit like 2024, like I was saying there. So, but still a good one to point out. But I guess if you were trading this, the stuff in Europe, you're probably more looking at electricity prices and gas prices, a bit harder maybe to trade that on an oil basis.
Yeah.
Unless there's a refinery fire, particularly from the US or that kind of stuff, then the obvious happens. But yeah, as I say, the more structural one to look at is probably fuel oil then.
Yeah.
In the summer. Okay, so that was the hot. What about the cold?
So looking at the cold, we're going back to 2021, which was a rough year. So we're looking in the States we had this storm Ida, which we've seen the phrase actually last year as well. I don't know if that's just when I became interested in weather, but this kind of polar vortex, this cold air being pushed down from, the Arctic down into the United States. So, through Canada. Just basically a quick description is that you have the polar vortex kind of spinning around the North Pole, and then you've got the jet stream below that, still like 5 miles, I think, above the Earth. But when the polar vortex weakens, the jet stream weakens, and that cold air can kind of pass down. And this was especially bad in 2021 during the Texas freeze, Ida, because there was this area of low pressure over the States as well, which is spinning anti-clockwise. The polar vortex spins clockwise, and that meant that
carnage happened.
Yeah, carnage
So this
happened.
this is what year?
2021.
Okay, 2021, because the Texas freeze that I thought maybe that was 2021 as well, but the one that we had in 2023 and into 2024, I think we at Onyx probably know all too well, because that was an enormous impact on propane, actually, right? It got so cold that you had the wells being frozen. And that was pretty unexpected. We got crude rally. We got the WTI kind of differentials going bid around some of the Texas areas. They're all kind of predictable on that front. But I think the propane one, we thought there was so much supply at the time. It was just not as expected to be so bullish. And I think we'd already had quite a big ARB rally. We'd already had quite decent spread rallies. So for it to really go on from there as much as it did, that was a blowout performance really for the propane markets and caught people by surprise. So again, it's a repeated one. When you see the Texas freeze, there are well, you can tell me, there's probably other trades, but for me, it would be straight to propane now. I'm always thinking.
Yeah, straight to propane. And actually, we'll come back to this a bit later when we talk about La Nina, which we're talking about with the trader kind of chat the other day, which is another really interesting way to kind of look at the intra-United States contracts, the regional contracts as well. But yeah, this is just an example of the electricity at the time, ERCOT, which is in charge of the grid for Texas, because it's not connected to the rest of the country, I don't think. They basically from 2021, in 2023 and 2024, there were far less severe power outages, which because after 2021 they were in such bad trouble that they had to weatherize, is what they called, the whole the grid. So that's meant that there was a far less significant impact on power prices.
But propane there was. And
yeah, that's different.
On retrospect, yeah, it was potentially, of course, the cold, right? Propane used for heating in homes. But I think the wells freezing, at least from memory, was the unexpected one. How can it be that cold that literally you can't even produce this stuff anymore? That's pretty nuts.
Yeah, that's
yeah.
And they're just not used to it. But this actually leads pretty nicely on to talking about La Nina, which is happening this winter. So you can see this is to do with the ESNO and complicated weather things. But it's basically, in each season, you're either going to get La Nina or El Nino or nothing. It's neutral. Right now we're in La Nina, which has been confirmed for winter. So looking at the United States.
Sorry, what's the difference? So La Nina is basically this, as you've got this chart up here.
Yeah, it's to do with the ESNO, whether it's positive or negative around the equator. There's this.
What does it literally mean? You get a cold.
Yeah, so this is the typical weather pattern of La Nina. Generally, you're going to get a colder. Like we just said with the polar vortex, the jet stream is less consistent. And as it's more variable, we expect colder air to be pushed down from the Arctic down lower into the states, where it's a bit warmer at the southern states. So this is kind of the expected pattern. And because of that, there's this differential in the states called the north-south differential between Conway and Mont Belvieu LST, which I think could be a really interesting thing to keep an eye on, especially.
Niche, though. Hard to trace.
Very niche, but
yeah, no, look, you can get some stuff off, and yeah, that is interesting. Sorry, so again, La Nina versus El Nino. One's basically La Nina's creating this pattern, and what's the difference with El Nino?
That creates just a completely different pattern. I don't have a graph for that right now.
But sticking to La Nina, then it's cold where? Sorry,
cold coming in from the north to down.
Yeah,
and then it should be, and also
so basically you're bullish to north south.
Yeah.
Bullish to north because it's obviously colder.
And also there will be an impact. Propane is used a lot for crop drying.
Yeah.
So the crops will be wetter and colder and they'll need more propane to dry them around the Corn Belt, around the Midwest, which is where it will be colder and wetter.
Interesting. Okay, and more domestic demand, I guess. And so just generally quite bullish, but particularly the north. Okay.
Yeah, sorry, that's very niche.
Cool. No, that's good though. I mean, again, this is the thing. So like we keep saying on all these different ones, if you want to know what's the real impact on the market, I think you are looking at the niche differentials. So you look, okay, and I remember doing it myself. So what's really going on here? We were like, okay, if there's real wells being impacted, like where is the main concentration of propane being produced? It's like, we're going to look at the Conway contract, not the LST. We're going to look, and I know it's a niche differential to LST, but we want to know what's going on there. So that will give us an indication, is this real physically or not? Or is this just, just a bit of hype and just a bit of positioning and speculating? And that's a really important thing to do. So it's just another reminder. It might seem super niche, but you hear La Nina, you look at the propane markets, look at the north-south differential to get your indication that it's real. That's very fair, I think.
Yeah, and of course scale matters. So if it's colder across the whole country, then there should be more demand for the whole propane market in the States. But
fair.
So lastly, just looking at cold weather in Europe, this is the graph of the LNG stocks year on year. As we can see, we're not looking super high right now. Of course, we're still,
Yeah, this is EU, right?
This is the
There's
EU.
all this talk this year is like, are we going to mandate the 80% storage that we have done before? Market was getting quite excited about that in that market because, it's basically essentially front run that, right? They front run the storage, but it got relaxed a bit in some I think some EU states, but whatever. The point is that was a factor. But I think what's super interesting about the storage and about the LNG story is that because LNG is replacing obviously a lot of Russian, when we had sanctions just yesterday, right, they're able to have these renewed sanctions because they've stabilized their supply, particularly for LNG from Qatar, from the US. so they can then squeeze the Russian supply again. So it might not seem like it impacts oil, but as in what's happened is because Europe are in a position where they're happy with their LNG storage, because it's cold, but it's not that cold, no one's too worried. It probably had a part to play in how they were able to go after these big oil and gas sanctions in Russia. You should never not look at it because it's political, right? Markets are so political these days. It's incredibly important to know what's happening in these core markets, even if they're not directly in oil, for this exact type of reason. That would be my addition. But generally speaking, it's cold.
Yeah, I think we're expecting a colder winter because of La Nina. Okay. But we're looking at decent levels. Like it's not like stocks are on the floor, like 80 something.
Yeah.
And we've seen there are more LNG kind of facilities to get all of the LNG that America's trying to ship us being built year on year, and consumption's trending down year on year. But we saw a spike the other day of just some stats coming out. They're a bit bullish and prices, jumped up. We're in a really reactive market, I think. Right. I think TTF is really, really reactive.
Okay, understood. Well, Martha, that was great. Thank you all for the summary, and thank you for the whole summary. But I think just to conclude a kind of major themes there, I'm just going to repeat it because it's one of those things that you want to say, okay, I want to buy or sell something liquid when one of these things happens, whether it's a very evidently a niche thing. Yeah. Even, hurricanes, heat, cold, whatever, it's always, but where, what's it specifically going to impact? And again, I would always reiterate, if it's a physical impact, you got to look at the physical market. You got to look at the differentials that are going to affect the physical market. So that would be the export differentials, like the ARB gasoline from US to Europe, or the other way around, Europe to US. We've got those North-South Conway. We've got all those kind of differentials like the Mars WTI for exporting. That will give you the confirmation on the physical side. Then obviously when you're trading the derivatives, you've got to weigh up other things like you always do, positioning and flow and all the rest of it. But at least you should know from these indications whether the story actually is real or if it's just a rumor. And I think that's kind of like the main message. And then trading off the back of it, I mean, I don't think we've been super clear how to make money out of that. That was not really the point of this, but maybe that's something we can do in the future. But generally speaking, there are key contracts. The air conditioning, it is about the fuel oil market mainly. Hurricanes, it is a lot about gasoline and maybe Mars and WTI to some extent. The cold, like you said, in Europe, it's really more about electricity and gas.
Yeah, gas,
but propane in the US. And I guess it's just having that up as an event trade or something you're looking at. In the case of, have up your list, hurricanes or whatever, these are the key contracts you've got to look at. And that will repeat itself all year round, every year. So cool. That was a great introduction. You'll be doing some weather shows going forwards. And obviously whenever anything happens that is significant to the oil market from a weather perspective, Martha will be there. So thanks for listening. I hope that was interesting, and see you again soon. Well, Chris, thank you very much for joining. Thanks for doing this. You're the first interview we've got in our new series. So thanks again.
Excellent, Greg. I'm very happy to be here. Thank you.
So I guess where I'd like to start is your book, Understanding Risk Management and Hedging in Oil Trading. One thing that stuck out straight away when I read it is you make that really clear point about, of course, there's price risk and there's hedging in the classic sense of how people think about it. But a lot of risk is moral, it's operational. There's so much risk to risk management than just the price. Was that something, and then you also said at the end, kind of a lot of the reason why you wrote this was because people just seem to know next to nothing when they come in. There's no real literature, I guess, to get a sense of it. And I guess for you, did you realize this straight away in your oil career, or is this something that you kind of developed, you found over time that was something structurally people didn't really grasp, if that makes sense?
Well, structurally, it was something I didn't grasp when I started out. I started out back in the early 90s with Total on the Middle East, East Africa subcontinent desk. And we didn't do hedging. We didn't understand market structure or anything. We bought and sold based on bill of lading dates. And even if the cargo floated around for 3 months, and if the market went up or down, it didn't matter. You just resold it based on the price at the loading dates. So I didn't understand any of this for the longest time. And had no formal training in this. My background, at least my education, was economics and politics. So I didn't really study much in the way of business. So I was plunged into it, and I don't think I was terrified because I really didn't know what I didn't know. So when I wrote this, it was designed for people who had no clue, essentially.
And I guess that speaks a lot to how the oil market has developed, because again, from my understanding, the early days that you're talking about in your career, I guess the volatility was a lot lower. Is that fair to say?
I don't know if volatility was lower. I think the the markets were in general a bit more naive. If you look back at the history of technology and information and also derivatives, the first oil swap was 1985 or 1986. I can't remember exactly which year, but around there. Yes, we had futures, but the markets closed at whatever it was, 5:30 for gas oil futures, and I think 7:30 for Brent, and then WTI. And after that, that was it. There was no market. There were no portable phones. On the weekends, people disappeared. So in a sense, there was no need to be overly sophisticated because there's very little you could really do in the market.
Well, that's fascinating. I guess with the benefit of hindsight and where we are now, imagining that is crazy. But of course, as you say, like that, the market was like that. So I'd be very interested to know, what was the turning point then? Is when people started to notice? Was it like a big price move, big loss somewhere, or where was that big shift?
I think one of the big things that changed was simply the technology. Once people started getting portable phones, you could be reached at any point 24 hours a day. When I worked in Singapore, I was commonly woken up by the office in Connecticut at 3 or 4 in the morning to talk about the market, as if I knew what was going on at 4 in the morning. But that also allowed people to start trading 24 hours a day and manage positions much more efficiently. Then, of course, with the internet and feeds over, I guess, first BlackBerry and then smartphones came along. And suddenly you had the market in the palm of your hand 24/7, and you could pretty much always find a way to hedge or find some derivative or something to do. So I think the big change was technology more than some sort of volatility or event.
Right. And I think when you say the technology, I guess, would you also say it was the derivative market developing on the one hand, but also that derivative market being visible through technology, right? That was a new thing.
There were markets that existed, but I think most people didn't really have a clue about them. Some of the early markets, European trading, worldwide, the Brent market, and even today, I don't think most traders in the market, certainly not product traders, and most crude traders outside that market, really have a grasp of what goes on and the derivatives and the things that are traded in the dated market, for example. So with more technology, there's more transparency, and people began to understand.
Yeah, understood.
I hope they understand. Those are in the market.
Yeah, it's fascinating to me how this is, I don't know if it's the only market that's done this, but it feels like, given its specialism, the oil trading market really has been designed by the traders. They've had problems like lack of transparency, or even things like you're saying, like bill of lading, there's no perfect hedge, like you say in your book. But the traders are always working on trying to find more ways to get closer and closer to that perfect hedge. And I guess I'm still curious, is that desire to do that, why would there have been that desire if the market was naive and still functioning well? I guess someone must have made some more money being a bit more precise and sophisticated, and just goes from there.
Yeah, this kind of history of derivative is not really my field. I mean, someone like Adiyam Sirovich probably knows a bit more about it. But I think it stems from the banks entering the market, just liquidity, transparency, and then the information technology. And once that became available, oil trading companies and oil majors who were trading decided that it was prudent. I know that at Total we had some, one of my first encounters with something called a backwardation was a cargo that was not really hedged because we thought we were selling it. And in the end, the buyer flaked. He just disappeared. He didn't want to do the deal. And we ended up having to hedge it on Singapore futures for fuel oil, of all things. Doesn't exist anymore. And I learned what backwardation was, because the hedge ended up costing us $3 million. So a cargo went from plus $1 million to minus $2 million, literally overnight. So that was a big lesson for Total.
Wow. Well, yeah, as I say, it's always interesting to hear it from someone who was there at the beginning, because it's always evolving in real time. So I guess from a risk management perspective, it's very clear, obviously, that the evolutions have been dramatic and ongoing. But maybe if we zone in a bit, like where do you think it's made us? Obviously, the technology came in, but did something like from the physical side, let's say, I guess getting more into, let's say, the shale oil boom, for example, in US, like you see risk management, at least from my perspective, seems to be a huge way to that, how that market's even built. Like my understanding is shale oil, to get the resource-based lending and to be able to start, you need to be forward hedging, and that was seemingly for me like a new thing. Would you agree that since the shale oil boom, or the shale oil boom, there's a lot of evolution in the risk management in the US side particularly?
I'm not sure if it's an evolution. I think it's a question of practicality. When you drill in a standard conventional oil field, you're looking at producing from anywhere 20 to 100 years of production. And you can try and hedge that, but realistically, how are you going to hedge 5 billion barrels forward? It just can't work. While a shale well, it's going to produce for a couple of years, really, maybe 3 years at this point before it really depletes. So it's relatively cheap in terms of investment, and it's relatively short term as well in terms of production. So it makes much more sense for them to go in and hedge. I don't know if shale, that approach to the market, hedging particular wells, drove hedging, or it just went alongside it. It's certainly true that these days, unless you're the owner of the company, you're not taking flat or outright positions anymore. It just doesn't happen. Everybody runs nearly flat book. No matter how big their exposure is at the bottom of the spreadsheet, it comes down to zero, or as close as can be. But I think that coincided rather than was being driven by the shale boom.
And I think to your point about it being some of these smaller wells and independent traders, I guess that's is something I thought about a couple of years ago, actually, particularly around 2022, when we kind of lacked a lot of the hedging from shale oil producers, because they were out there saying, look, what do you want us to do when every bank is calling for like $150 oil? Why would I hedge, right? And that's kind of a fair point. But the other way to think of it is when shale oil independents got absorbed more through acquisitions, and it feels like, and again, this is not my expertise, this area, but it feels more like it's much more consolidated, the shale oil and the independents and the Chevrons, the Exxons. And they must think, as you just said, that they're such huge players. They must think of hedging and risk management in this area very differently, right? That's a fair point to make.
If you take someone like Exxon, who had a foray into trading, it sort of fell apart. Now they're coming back again. Exxon never hedged. Up until 2018 or so, Exxon never executed, as far as I know, maybe just on a whim, a swap or a futures hedge or any sort of hedge. Exxon said, we're too big. What are we going to do? We're just going to move the market one way or another. Or we're long here and short there. What's the point of hedging? We're global. So the oil majors tend to have the same approach. Again, I've only worked for one major, that was Total. But I know what happened inside Total. They didn't generally hedge their big exposures on equity, oil in the ground, refining margins, those sorts of things. I think most of the oil majors and large producers, national companies, whoever they may be, look at it and say, we're in this for a very long term. We're going to make money doing this in the long term. In reality, oil is free in the ground. So the only cost is the price of production, the cost of production. So in terms of hedging, it might apply to something with a very high cost like shale or oil sands, those sorts of things, or even perhaps in the North Sea, where you start to hit up toward $50, $60 a barrel production. But for an oil major or a national oil company, I don't think it makes sense to even try to hedge. I don't think the liquidity would exist for them.
Yeah, it's so interesting. That's such a good point. I mean, and I think that if I'm speaking as a derivative trader now, when you're trying to gauge the physical versus what the benchmarks are doing, it's so easy to say, but the refinery margins are strong and the cost of production versus where the price is economical. We should see more oil here. We should see more oil there. But how it actually translates into the price is a function of people actually clicking the button and trade, right? And if they're not doing it, how that filters through from basically what the physical market is doing into the paper, that's where the dislocation is. And I personally see that as like one of the biggest misconceptions when you're thinking about analyzing the derivative market versus the physical. But I guess in your perspective, do you have a similar view on what people misconceive generally with risk management or do you look at it completely differently?
I'm not entirely sure. I get the point of that. I sort of see where you're going.
Sorry, no, I'm being difficult. So I guess what I've got here is, the biggest misconception about oil price risk from the difference between a corporate manager and a fund manager, right? So a corporate manager, like you just said, would be thinking it like, we take a long-term view, we're in this market for a long time. Whereas a fund manager is saying, well, the physical's doing this, so the derivatives market's got to do this. It's like that's a big difference, right? You see what I mean? How people look at the markets.
I'm not entirely sure just how in touch with the front end of the physical market the fund managers are. The really sharp end, the first couple of months or 3 months. So they're looking forward for more macro things, OPEC decisions and new refineries coming on stream, that sort of thing. From a corporate point of view, as far as I can see from people I've worked with, companies I've consulted with, or companies I've worked for, you build a refinery, it's notionally going to last 100 years. And you're in the business because you think you have good engineers and you understand the market and you're building something that's going to be profitable. So I don't think they generally go into it thinking, well, I'm going to build this refinery and hedge it, or I'm going to drill for oil here and hedge it. It's a very long-term approach, and I think they approach it simply as a business. The same way a baker doesn't hedge, his wheat input and his loaves of bread output. He's just in the business thinking he'll make a margin.
Yeah, no, that's exactly. I think that for me is one of the biggest problems people on the outside of the physical have. They want to believe that if there's something happening in the physical and that they're aware of, it should translate into the price. But there's so many different ways of thinking out there. People in the physical world don't look at derivatives like the be all and end all, right? They're looking at things potentially very differently. And like you say, like if people are taking macro views, no wonder things get distorted, because it's just like one economic model versus a completely the other. But just for someone starting out, then, I mean, that's a very confusing kind of thing to hear, I would say. So what do you, I mean, of course, your book's a great start. I mean, you get a good overlay of how people are thinking and what they're actually using the derivative market for and what they're using risk management for. But do you mind if I just ask, like, what is your advice for young people given the state of the market right now?
Well, right now it's a difficult market today. The market's volatile, but non-directional. So that makes it confusing for a lot of people right today. So I think a lot of people's views in the market today are a bit skewed by what's happening today. It's harder to get into the market than it used to be. I started out, I was hired, I had no background really, any serious background in business, finance, accounting, or anything. I really didn't know what I was doing in the beginning. And I was plunged very quickly after practically no training onto a trading desk and let loose on the market. That doesn't happen these days. People are hired by companies, whether it's a Vitol, Trafigura, Mercuria, or an oil major, and they go into pretty extensive training programs, passing through the back office, middle office functions, sitting as a desk assistant. And it's getting hard to get in because, for a while after the various crashes and COVID and what have you, Wall Street lost a lot of its appeal with restrictions on bonuses and salaries. And it's become very corporate. So people turn to Vitol and companies like that because they saw the headlines, billions of dollars in profit. So Vitol, now the oil majors who have trading desks and whoever, can pick and choose from the top business schools. So they just make a selection of, here's one from MBA, here's one from Harvard with an MBA, from Stanford, from MIT, whatever it would be. So it makes it difficult for people to get into the market where they are familiar with it. So my advice to young people is, if you want to get in and become a trader, then you need to probably start somewhere smaller or start somewhere else in a larger company. But the idea of I'm just going to go and get hired and become a trader and be driving around in my Ferrari in a year doesn't work that way anymore. But there are other ways to get in. Broking, working for an inspector, working for a storage company. There's lots of entries to the market where you can start to learn and see who's in the market and do you want to do this or not?
Do you think there's a big difference between the US and European life or work in oil?
Oh, I don't know. I've never traded in the U.S. I've only ever, I left the U.S. back in '88 or whatever it was, and I started working in trading in Paris, then London, Singapore. So I've never traded in the U.S. So I don't really know.
Yeah, no, it's interesting. It's just some of the way they think about hedging, like you say, in the bigger companies. it feels like maybe they're not behind anything because they're huge and sophisticated, but they've certainly not looked, like you said, they might not even hedged ever before with some of these companies, but they don't see the need to. And I wonder that dynamic must be very, very different being in a US based firm in oil than UK. But as you say, like it's hard to know without having actually done it.
There are differences if you look at, historically at least, hedging by someone like an airline. When I traded out in Asia for some of the banks, trading options, basically marketing options, running an options book for airlines, they were willing to do very exotic options, highly leveraged options, 4-to-1, even 5-to-1 collars, those sorts of things, leveraged three ways, what have you. And they could do that because they didn't have any restrictions from an accounting point of view. While at the same time, US airlines could really only do fairly simple hedging because otherwise accounting and regulations and reporting restricted them. They simply couldn't do it. So I think the U.S. corporates are probably behind in that because, which might be a good thing, frankly, from my point of view, simply because they weren't allowed to do it. It would be too onerous from an accounting point of view.
That's very interesting. I mean, there's been some interesting books. I don't know if you've seen the Secret Club That Rules the World. That was the one a while back. And there was a story. They went through all the Delta Airlines buying a refinery and things like that. All these inventive ways.
People, companies have gone in. I was involved in, my students or the participants in my courses always ask me, what's the most money you've ever lost? And was involved in one of the largest trading losses in oil trading ever. I left the company well before it all exploded. But I worked at a bank in Singapore and we marketed options to I'll call it a developing country national oil company for their refining margins and other things. And when I did it, I told the company that this was a big mistake, that we shouldn't be marketing this because the client didn't know what they were doing. But they went into it. We sold them a bunch of options. Other banks saw what we were doing, followed them in. And it turned into, I think, a total of about $800 million in claims. Much of it was paid out, but it's probably still $300,000 or $400,000 in losses for the banks that were involved. So, yeah, not everyone's completely sophisticated. This wasn't that long ago. This was 2000, 2007, 2008.
Well, I guess that was the time where the banks were probably at their peak, right? And I guess they finding inventive ways as salespeople to get people to hedge, like you say, there's collars, there's leveraged collars. I mean, these days, I think there's a general understanding like that stuff can get very dangerous, but it hasn't deterred people from hedging. But I personally don't see as much of the non-vanilla structures. But I could be wrong. I don't know. Maybe you see something different.
No, I'm not in the market doing that anymore, so I don't really know what's being marketed to these companies. For the most part, when people ask me for advice on hedging, I tell them to, if you don't understand what you're doing, you probably shouldn't be doing it. So one of the reasons that these banks, and now I guess the trading companies, even the oil majors, have desks doing this, marketing these things. The reason why they market more and more exotic options, leveraged options, knock-in, knockout, wedding cake structures, all these sorts of things, is because they got competition. Originally, it was the banks marketing straightforward caps and floors, and then became collars and then three ways. And those are all vanilla. And as soon as you get competition, there's no more margin. So then you have to start building in something exotic where you can start, hiding optionality and hiding margins in there. That sounds like a very negative approach to the whole thing, but that's my point of view on it.
Yeah, sounds exactly right. And I guess it became also a function of financing as well, right? Like if more and more people are in the game and able to offer the same financing, it's less of an edge. So you've got to do it more with the structures. But yeah, no, it's interesting. So where do you think it goes from here? Do you think more and more people are going to hedge and take the view that it's going to become almost like foreign exchange, right? I mean, a lot of people are familiar with foreign exchange hedging, but oil and energy is way behind from a corporate sense from that point of view. Do you think that evolves?
I don't see the corporates doing that much more. As I said earlier, oil traders and the trading departments of any company are pretty much running flat books. So everybody's hedging on a flat basis. It doesn't mean they're not taking massive positions. You mentioned earlier about this possible disconnection between physical markets and the derivatives markets. Physical traders are trading or hedging everything they have on a physical position, but then they go far beyond that, because once you've done your hedge, you've locked in your result. And how do you make $10 billion a year by simply trading physical oil? You don't. So they end up taking very large positions on various spreads and things. So they are trading massive amounts of derivatives, but at the bottom of the page, it's zero. For the corporates, I think that's been pushed far enough, and I think a lot of corporate companies have seen articles and headlines, and they're willing to do certain things, but they're a little bit more reticent about getting involved in too much exotic stuff. But again, I'm not in the market today. I might be wrong.
But it's just like you say. Yeah, no, it's fair. But I just think, again, like with your book, it's not a simple concept, but I think the information out there is increasingly democratized. And I don't see why, at the very small scale, you can't protect yourself, even as an individual or certainly a small company, against things that do impact your business. You have very small businesses, but they have to use diesel every day, and their businesses can be really stung by diesel price spikes. Why can't these companies be more active on the hedging side? I would argue personally that it's not even considered an option because it's not been very visible. But I think that if that was the case, you could see a lot more, basically, is what I'm saying. And that's maybe where I see it going, but you might say it's just too different. I don't know. That's why I was interested in your opinion on it.
Well, I don't think they have the knowledge, as you said. It's becoming democratized, but a small company running a factory burning diesel, I don't think they think about hedging. Or if someone suggests that they hedge, they're going to go, oh no, I don't want to get involved in hedging. It's gambling, it's speculating. So it's a question of understanding. And again, one of the reasons I wrote the book was for people like that. Now, I don't know if someone running a factory in that way is going to actually pick up my book, because he's going to look and say, this is a book for oil traders and not for me. But it's, I didn't write my book for oil traders. They should already know this. I wrote this book for effectively corporates or HR or somebody who has no clue whatsoever. So perhaps if everybody bought a copy of my book, we'd see more hedging. I don't know.
Well, that's exactly what I'm trying to say. I think they should, and I agree. But I think that there's something about oil, though, is there not? It's so niche. Like even the bigger macro high frequency trading firms, they seem to really struggle with the nuance and the domain knowledge of oil. So what do you think is the hardest concept that's hard for newcomers to grasp who aren't professional oil traders?
One of the difficulties is it's a commodity. Crude. Well, let's talk about crude oil, because products makes it even worse. But crude oil is a commodity, but it's not just one commodity. It's semi-fungible. A barrel of WTI Midland, a barrel of something in the North Sea, a barrel of West African, similar, but not exactly the same, separated by some quality differences and separated by contractual terms and freight and logistics costs. So I think that maybe the big hedge funds are trying to look at this as a very, very big picture, and sometimes they miss the smaller moving parts. The market can be driven by micro things. In one market, what's happening in the North Sea? Is the Forties field shut down? Missing a couple of nominations or lifting coming out of the U.S. Gulf Coast, and misjudging the amount of exports or stockpile builds and things like that. So I don't think it's like gold trading. Gold doesn't do anything. It just sits there. People dig it out of the ground and then put it in a hole somewhere and just leave it. So it doesn't move. It doesn't physically move. And gold is gold, like most precious metals. It is what it is. But oil is different all around the world. And it gets even worse when you start to talk about product markets, because many product markets have different specifications, different ways they trade, sizes of cargoes. So understanding those flows are important as well, because, as you mentioned diesel earlier, in order to understand the value of crude oil, Brent or WTI, if you don't know what's happening in diesel markets, you're missing a significant part of the picture.
But I guess someone just they only need to worry about their product that they're consuming. I guess maybe another thing it's difficult is if we say, let's talk about the UK market. Why don't you go and hedge your diesel? You'd be like, okay, well, where's the UK diesel contract? That's also, and the different, the words are crazy, like CIF, Northwest Europe, like barges. It's like, what the hell does that even mean? I saw like Prince Harry on an ICAP charity day. He was saying that as confirming a trade. And he's like, what the hell did I just say? I think that's half the issue as well. Would you agree with that? Some of the nomenclature makes it harder.
There are lots of prices out there, and people don't necessarily know what they represent. And this is often, sadly, the case for some people who are in the market who should know better. They're dealing with these prices, these Platts quotations or Argus quotations, and they don't really know what they're made of, where they come from, how they're formed. So if you're looking, someone who's hedging their diesel exposure as a domestic consumer in the UK, first of all, 75% of their price is not the price of the oil. It's the price of taxes and duties and wharfage and customs and all these things, VAT. The residual bit is tiny. If the price of oil doubles, it doesn't mean that the price of their diesel into their factory doubles. So there's really no market for them. There's no derivative to cover domestic prices, or if there are, they're extremely limited and illiquid. So getting in and out getting in might be easy. Getting out is going to be a bit of a problem.
That's something I think we're working on, but yeah, I completely hear you. Yeah. Well, this is what I'm saying is in like, I have a lot of sympathy for someone saying, yeah, okay, fine. I know I'm exposed to diesel prices, but like, what do you want me to do about it? It's such a crazy, I don't almost think or feel sometimes it's by design that it's not simplified. I mean, you go on IG Index, they do have UK diesel. I think they do, or they have UK oil, I think. And I think that's essentially a tagline for Brent. And I guess it's a lot more relatable. I think the more we get at that, the more it's like, okay, I kind of get it now. And then they can pick up your book and say, right, what am I actually doing here? And I don't know, I feel like it's not like you have to, but it wouldn't be a strange thing to say, look, if you're going to constantly go to Japan 3 times a year, are you going to think about your currency exposure and convert it early? Yeah, people think like that. So I don't see why they can't with oil. So I hope people will think of it like that more in the future. And as I say, use helpful books like yours.
Well, it comes down to having, again, a derivative that fits your needs. If you say to someone who's got diesel exposure in the UK, well, you need to hedge yourself against oil price risk, and he goes out and hedges with something liquid and trades Brent futures, things can still go very wrong. That's far from being a perfect hedge. So until someone can find something, first they have to understand what they're doing, as you said. And most people, I don't think, really outside the market, don't really understand simple concepts, which is why on my book I've been both mocked and lauded for the cover of the book. If you can see that, it doesn't look like a typical oil trading book, does it? With the smiley faces and frowny faces. And I said it's because it's not written for oil traders. It's written for people who have no clue. So when I have little reassuring things like little smiley faces, so they can understand it in a very simple way. So first they have to learn and understand this stuff, and then they have to actually find a market that applies for them, which it doesn't necessarily exist for a lot of these smaller consumers.
Okay, so I guess final question for me: Do you have any view? Maybe not about the physical oil market. I mean, demand's still super high, supply is still super high, it's at least around for 10, 20 years. But do you see a big future for oil trading? Do you think it gets even bigger, or do you think it's getting different?
I get in trouble for this because one of the things I do is I teach oil markets, oil trading, logistics, operations, these sorts of things, contracts. That's part of my job. So I travel around the world doing that, and I'm in agreement with my colleague Adi Imsirovic, who I worked with actually in Singapore for Sempra years ago, that we're going to run into a problem where we're not going to run out of oil, but we have 2 issues. One, we should probably stop using it. And the other is that ultimately there's not going to be enough to really have a trading market. So I think in 30 years, we're either going to have the decision that we're not going to be burning oil, which means no more trading of oil, or even if we are, we're going to end up in a situation where those who have it will keep it. And what happens to the trading market when you have, for example, Saudi Arabia producing 6 million barrels a day or something like that, and using all of it domestically, and the same for the other large producers. So, people ask me, how long will this market last? And I don't really know. But based on what I've read and studied, my best guess is effectively 30 years, maybe as short as 20. So if you're a young guy or a young woman getting into the market today, you've got to make as much money as you can in about 20 years, because after that, I think opportunities, at least directly in physical oil trading, will probably be limited.
But at the same time, there's a lot of lessons to be learned in any trading field to another. But I get oil, again, like I said, it's very niche and domain. There hopefully will be some decent translation of knowledge into another market, right? I mean, that could well happen.
Well, the fundamentals apply. I wrote my book, and I talked about hedging and oil trading because that's what I know principally. I have taught classes at business schools in France just about commodities in general. So, someone said, well, do you know a book about natural gas trading? I said, well, just take my book, and every time it says oil, just white it out and write natural gas, because the fundamentals apply: long, short, hedge, all these sorts of things. All the other things I talked about, moral risks and legal risks, they apply across the board in any commodity. So yeah, once you've acquired the skills in oil trading, you should be able to move across to almost any other commodity, or even most other financial instruments. I've known traders who've gone from trading oil to trading ags or trading gold or even financial derivatives. So,
Chris, thank you very much for your time. It's very interesting. And again, your book, don't mind plugging it at all. Very good and simple, as you say, clear for people, understanding risk management, hedging and oil trading, a practitioner's guide to managing risk. If you're new to the market, great book to pick up and get cracking. So thanks again, Chris, for your time.
Thanks, Greg. Thanks for having me.
Where do you draw the line between insider trading or inherent risk protection? I think it's a very hard line to draw and to say this is bad, this is sin. So one should accept it, that people will operate based on what they know. And this makes it so interesting because now even the producers, the big ones, the OPEC members, have trading arms. And those trading arms, of course, they're going to know stuff that the rest of the market doesn't work. And why should they not trade with something they know or is coming? One should also accept that, right?
Governments as well. It's not just trade houses. It's governments. It's the US government. It's the Chinese government.
Yes.
Jorge, what have you learned the most in the last 6 months working under the officials?
That good information always has a market. And obtaining it, delivering it direct, people cannot avoid it. The most important thing we have done really is in telling a narrative as we truly think it is. And the market reacts very strongly for and against that. So what I have learned really is you have zero friends and in a way, zero long-term enemies because everybody turns depending on the circumstance. So you just have to hold strong.
What do you think the most valuable thing the officials does then?
Really telling the market very direct things with zero government, OPEC, or trader narrative. We're truly telling the market how we see it without any interference or fear. I would say right now it's a very good example. OPEC has been releasing information that is going to increase more production or less production. Some very big agencies, I found out this morning, are saying that OPEC has spared 2 million barrels of capacity to unleash on the market. That's not true, but somebody's saying that, and people repeat it without thinking. So what we add as value is we think about what is being said, and then we add the commentary saying true or not true.
Like an investigative journalist type approach, being pragmatic and critical thinking.
Correct.
What do you think is the biggest difference, given you've almost done 18 months, almost exactly?
Yes.
Since 15 months ago and now, what has been the biggest change?
The biggest change is when we started, we faced animosity from all the traders, the big, large trading houses, and even the publishers, as we brought in a transparency they were not accustomed to. Prior to us coming into the officials, everything was being said in a manner that was super polite, hiding stuff, and not calling anyone's bluff or nonsense, if I don't want to use the B word. And we went in and said, this is really what is happening, you're doing it, and we are going to describe how it is. And we face a huge wall of opposition, lawsuits, really ugly stuff that, in my opinion, was unnecessary. But I also know that if you hold your line and you believe what you believe in and you know you are correct, eventually they dissipate. The bad energy dissipates. So the biggest change since the beginning to now is now we are, in a way, accepted. The market accepts that we tell it as it is.
Thank you. I think all those set us up very nicely for a longer discussion. And yeah, I think everything you're saying makes complete sense to me. And it's amazing in a way to think how far it's come in 18 months. And you always told me that 18 months is how long it takes to know if you've got something.
Yes.
And I think no one could deny you've got something, right? Many thousands of views on your daily reports, but interest and so on. And as we move towards monetization and trying to make it a more standalone business, all the right signals are there. But I guess what I would want to know more about from your point of view is when you say things like the market appreciates when we're thinking about things and being critical. To me, that speaks of, it works because of where markets are these days. The markets are much more transparent, and a lot of people are utilizing the financial markets everywhere, right? There's, insider trading left, right, and center in Congress in the US, and you kind of get the sense that it's in every major institution's aware of how to use the financial market for their benefit. There's information sharing, and it's almost like the heartbeat of everything we do in general. I think it's gotten to that stage. So do you think that, therefore, given information is quite available these days, and media headlines, everyone's got them, they're not as directly influential anymore because we know people are using them, as you said, to influence their thinking or influence other people's thinking on their behalf? And do you think that's where it's at right now? That's what you're trying to focus on in a way?
Yeah, and there is perhaps an ugly part to it, or something that one has to accept as the reality of the market. If you're a refinery and you know that there is a turnaround coming in and you will need to buy loads of gasoline, it should be wise to think that that refinery is going to buy some paper in advance because they know they will have an influence on the market. Or if a producer knows that some well in the North Sea is going to have a mechanical issue that needs some repair that is off schedule or on schedule, maybe he will also go along some swaps.
That's insurance, right? This is how you manage, this is the whole point of financial markets, really.
It's inherent.
Yeah.
It's inherent. And where do you draw the line between insider trading or inherent risk protection? I think it's a very hard line to draw and to say, this is bad, this is sin. So one should accept it, that people will operate based on what they know. And this makes it so interesting because now even the producers, the big ones, the OPEC members, have trading arms. And those trading arms, of course, they're going to know stuff that the rest of the market doesn't work. And why should they not trade with something they know or is coming? One should also accept that, right?
Governments as well. It's not just trade houses, it's governments, it's the US government, it's the Chinese government.
Yes. So the Chinese government may release it to an arm that then acts on it, and then another one gets caught unaware. So one just has to assume that people are running books ahead of something or somebody else all the time. And that makes trading very interesting for people like yourself because you're facilitating the buyer and the seller to buy or sell that protection in markets. And that means the liquidity is doing this.
Yeah. But again, what I'm to keep going on what you're saying from the official's point of view is the need for journalism has evolved, or its request from the market has evolved. Not that they formally requested it, but you are commenting on the second, third level thinking, because the first level thinking of what is the headline, what's going on, is being served now, isn't it, with the world's digital and social media access?
Pretty much, but there's still a kind of hidden information that should be on the front line, and it's not. Okay. And then a good journalist will ferret it out, or he will be misused as it happened last night with the Bloomberg report, where OPEC or somebody in OPEC released information that wasn't very good.
But that's a great example. So OPEC release information to the journalists that they think that 500,000 barrel increase is going to come with the next meeting. The journalist does their job and releases what information they have, and the market reacts to it. But it would have been very strange or very conspiracy theorist style to say, well, they're clearly lying. I mean, I think if you said that on a trading floor a few years back, people would say, yeah, they'd roll their eyes. Like, yeah, of course you would, but who knows? And it's not likely they're using that information the wrong way. That's completely flipped on its head. Everyone assumes now, like you say, that it's some kind of agenda that's being propagated. But that's my point. So that's where you're trying to sit as a journalist, right? The next evolution of journalism and energy
is to figure out the agenda, clarify that agenda, and give the reader an explanation on what is the most likely outcome of that agenda.
Well, I think that is incredible because, and I don't mean to be disrespectful to any other journalists, I really don't, because they're very excellent editors, copywriters, they have to do their thing, and it's impressive in its own right. But the new evolution of the journalist, you need to know a lot about markets, intricate. You need to know a lot about the players and how they think. You also need to have a brain that thinks with an open mind, and that's a lot to ask for a journalist. That's what you typically expect in a trader or a top government official. So it is difficult to be a top-end journalist in that respect.
Yeah, the game has definitely moved up.
Yeah.
Because if you think at the core of the beginning, journalists really in their hearts, they want to obtain the truth and publish the truth. And you assume inherently that somebody's going to lie, so you
Sorry, that's quite a big statement. Do you think that journalists want to publish the truth?
The truth. They do. They do. I have worked with many of them.
Okay.
But
they
get cheated sometimes, right?
Yeah.
They're not as qualified.
But does truth count as the truth of what someone has said, not necessarily the truth of what's behind what they said?
And that's the difference
Okay.
I want to make. Some of them, unfortunately, are a little bit like parrots. Mm-hmm. So-and-so said, I write so-and-so said. So I'm just repeating, being a conveyor belt. While I think the real value add, and more so because markets are so complicated, and as I indicated, OPEC members have trading entities and majors have trading entities. So you don't know whether they're really telling you the truth or not. So you need to really think, weigh what somebody's saying, weigh it with somebody else, and come up with an opinion inherent in the news.
So this is why you get niche media outlets and social media channels launching, because when a media arm in particular, but any business becomes a real business in terms of size and scale, the more likely it is that there's going to be their own agenda or their own quarterly results they need to maintain. They need to keep advertisers on board, and there's all these other things that come in and affect what they're originally always about. So naturally you get these kind of guerrilla journalists, if you like, spouting up to tell a new version of the truth. It's always going to be that way, I feel. Having said that, if I look at the situation with Platts, Platts to me have never really marketed themselves, in my eyes, as journalists, but the more I've gone on, the more I realize that is, of course, the business model. And they do comment on most markets, and I guess you set that up, the whole commentary by contract and things like that. But do you, and I think you've spoken to some of them who say, I wish I could speak like you.
Yes.
But they're not able to. Do you think that's because, as what I'm saying, it's just gotten too big, even though, if you said Platts to, I don't know, some FX trader, they wouldn't know who you're talking about. But in our game, they're the biggest, them and Bloomberg are the ones that report on this market the most. Are they restricted to be able to tell these things?
I know many former colleagues or people I work with or have switched jobs, not only in Platts, but in Argus or Reuters. We have been part of the same community. And there are many kinds. Some really want to tell the truth. Some are, this is going to sound terrible, but it's a good analogy. Some are lazy parrots, right? They just repeat what it says. And some are corporate beings. So if the top says, don't ruffle too many feathers, which I think is the case in even in the FT, they don't say many things that they should say about things happening in the Middle East, for instance, or even Bloomberg, or Platts with some of the big corporate clients. It's like, don't use the word squeeze. When I was in Platts, we were forbidden corporately to use the word squeeze.
You never told me that.
While squeezes were happening.
Yeah.
So I negotiated with my boss to use the word buying spree.
Okay.
Which was our code for squeeze, and the market knew that it was the code for squeeze. But that just tells you the corporate interference. And really, one of the things, I'm going to say it here, that I appreciate of working for essentially what it is another arm there, a trading company, or so close to a trading company, is that nobody tells me what to say or not to say. It's complete editorial freedom, and this is the way it should be to be of value to the reader. Mm-hmm. That the journalist is saying it really how he sees it.
And we got from a trade house, didn't we, that the claim that we were trying to hurt a competitor by talking about the market, which I think is obviously clutching at straws, and it's a silly narrative, right, at the end of the day. But you can see how they probably...
I think they would want to say that, but validate it and come see how we work.
Yeah, yeah. No, it's very interesting. But again, I want to stick on the evolution, if you like, of journalism. I feel, again, it's very restrictive, the position that Bloomberg are in, and as you said, FT and Platts. And there's this need to find information. But if you expand it to Kepler and to Energy Aspects, which are also major sources of information, I don't know. I'm so biased because I've been on this journey with you, and before thinking, this is not the real truth. But the market has caught up to this way of thinking as well. And there is increasingly a demand for real transparency, or do you think that's just in our heads?
No, there is, and it is understood in many areas that some large corporate or government bodies buy a lot of services from a supplier and then expect a quid pro quo.
Right.
And they expect for their phone call to be received immediately, to be told, don't say this, and then you don't say it. This happened really last year around IP week, where if I counted right, 11 journalists or consultants came to me from various publishing houses and consultancies that they had been told by OPEC to modify the narrative in their favor. I mean, like straight, do it or we cancel the subscription. And
which I think particularly for an Energy Aspects would say a lot of our reputation is built on having a tight relationship with OPEC. So if that goes, then the whole thing kind of unravels. Maybe that's their fear.
Yeah, I think to be very fair, I'm a very strict guy. I didn't speak to anyone from Energy Aspects, but I spoke to many others who do the same job as they do, and they were tapped on the shoulder, more than that, hit on the shoulder. So
well, I can understand as in when you get to that value of a business enterprise value, you're talking into the billions.
Yeah.
It's a very rock and the hard place position to be in, and then it becomes about why you're doing it in the first place. And I think a lot of the people who own these businesses, particularly if they have private equity involved, it is about making money at that point, and they've got to serve that, and that's where they are. They've lost their need, if you like, to have a kind of real value extraction where we call, having a nice to have to becoming a must have. It's becoming like embedded in the industry, and then becomes like a legacy thing, and it's almost there because it's always been there. Like Pyra is now part of Platts. That's stuck around for a long time, probably way after it lost its value in some people's eyes because of the power of these things that are embedded in our industry. So I do sympathize, and I don't think they can, these consultancy firms can just turn around and suddenly say, oh, well, Jorge is saying what he likes, I'm going to say what I like. I think that's a very risky game. Yeah. So, and I understand, but I guess my point was always in the last 10 minutes that it is about the next evolution is coming. And it's a great opportunity for the officials. But I think it's a great opportunity for others out there who probably don't, hopefully from our lead, aren't as worried to say information that you shouldn't say, whatever that means, which is, it's going to be interesting.
Yes, because for this, I'm going to call them all publishing houses because they publish stuff. They have been, for the past, I think, 5 years, kind of bowing down and accepting and forming the narrative in this way or that way, or avoiding touchy points. They really avoid touchy points. And they have seen the work we have done at the officials, and the fact that we walk around without fear. We said it, it's us. And we know that the reports go hand to hand, being shared. Can you believe what this guy said? Well, if it is the truth, you should be proud of it. And I would like to, in a way, help the competitors to feel
I agree.
more empowered to say what it is, right?
Well, we're coming from a position where, I don't mind obviously admitting, you don't make a profit. It costs money to fund this. And sometimes, I'd like to believe that we're showing the evidence that we're doing this for more than just the money. We don't have private equity.
Yeah.
Me and Omar own most of the business and a few employee shareholders, which is the best place to be in. No one can tell us what to do, right? We own and run our business. you should maybe worry if someone does come in, because at that point maybe we're under the same corporate pressures of, you know, so and so. But I think we have a big, larger plan for the industry for the next 30 years. And I think that means we can do things like this, and that means that we can say things like, we want the competitors to also do this, because we want this for the industry, because the larger goal here is for it to be massively opened up, democratized. You know, we're going to benefit from all that kind of stuff, and I kind of like the idea of that happening anyway, and I think you definitely do too, right? I guess I agree with you saying, like, in a weird way, it would still be successful if it doesn't make much money, but it's changed the way we do things in the industry. There's still a win in that, right?
Yeah. And I'm very appreciative for that understanding and freedom. And what I have been trying to do is to set a culture within the officials of say it as it is, respect the journalistic integrity, and just go for it. And I was chuckling a little bit when you and I were in Singapore for APEC, because there was a question about something, about who said that. And of course I knew who said it. And then you say, he doesn't even tell me. Because my sources are my sources, right? They're not your sources. And that line needs to be super strong.
Yeah, no, fair enough. You led me to a good next question, which is, again, they're not the problem, but the challenges that these businesses have when they become bigger and more embedded in an industry, which is succession. Because you lead, and you see this with every single business, again, not singling out Vitol, but when Vitol was run by Ian Taylor, you know, the business was very much, you could sense him everywhere. Even I was barely fresh in the industry when, you know, in 2013, but you knew that he was out in the media, he controlled the narrative, and he definitely had a handle on his own firm, right, in terms of how we're going to be, and he spoke for Vitol, and it kind of bled through him. When he left, to be fair, I mean, Vitol got more successful than ever, they obviously with the 2022 stuff and all that. So my point is that it can go that way, but it can also go other ways, which is like when you left Platts, which is like, well, what does it become when a strong person with a very clear identity of what the business is all about and should be goes? And that is my worry. And people do ask me, what are you going to do when Jorge leaves? And, you know, that is an important thing to discuss. No?
Yeah. I think at the core, you have to define whether the head of the publishing unit is at odds with the corporate unit.
Okay.
Because let's assume, taking another example, if Ian Taylor and his successor and the company are aligned, then when Ian Taylor phases out and Mr. Hardy comes in, then it's just a transition of the same system. But I was at odds with the corporate management.
To begin with, and throughout.
Yeah, in Platts. So when I moved out, then of course the corporation says, we're going to do things differently now, this way.
Now this annoying bugger's out of the way kind of thing.
Yeah, so correct. So here, for when my time comes, then, well, it will be up to you or to whoever to say we're going to continue as it is, or we're going to do it differently in this way.
Or are you able to do it the same? You know, there's a whole, like, you know, Shakespearean style stuff, you know, Succession, that program, and all this is a fascinating topic, Succession, because it's not just about, you may want to keep it exactly the same, but do you have the management to deliver that? And that is tough.
Yeah, and I think you can see how I work with, I'm going to call them my guys, but it's share everything, make them grow, make them take decisions that are hard, but share all the knowledge. But it requires time. And over time, I can see that, yes, they're growing, right? That's the beauty of managing a team. Young people, eventually they grow. And can they be personalities? I hope they are. I mean, I'm very proud when I see them already being personalities on YouTube equivalent, right? So,
well, there I guess you kind of said it for me, which is, and again, I'm not trying to over-egg this, just analogies, you know, when a new king or a new prime minister or a new, even head of a desk, actually, a story where the trader told me this about six years ago. He took over a big North Sea trading desk, and he came into the Brent expiry, lost a ton of money, And I spoke to him afterwards, and he was like, yeah, well, I needed to announce my presence. You're thinking, on the face of it, he lost money, but I kind of get his point. Like, if the game is about who controls what, and the North Sea game has always been a very poker-esque game, who's got what cargo, who's going to do what, he needed people to think, or he's a force. And so I actually kind of get it now. I wasn't as sympathetic then. That is something that every football manager, whatever. So someone comes in after you, they're not Jorge, and they can't pretend to be Jorge as well. Yeah. So the first thing they need to do is win a battle, win some territory. This kind of stuff. So that we'll cross that bridge. But it's just fascinating to think about, in general. And I hope you can engineer. I hope that is your last swan song, right? Not just developing something amazing.
I hope I keep going.
Yeah, exactly. You've got a long way to go. No, seriously, absolutely. But my time will come too.
Yeah.
And I think that's the most powerful way to leave. To leave it in a way that it's actually still standing the way you envisaged it.
Yes. My commitment is really to the future, for things to continue and be better. Because you have to recognize that at some point, maybe your brain is not as fast as it used to be, or your health is not as good as it used to be, whatever, right? Or the market has changed and is using new instruments that it takes you more to learn how they work.
Absolutely.
And that's where you need, like I see my folks working, man, they use Python in and out, right? To accelerate the processes they do. You give me Python, I think it's gonna bite me. It's like, I don't know what it is, right?
Yeah. I think I'd like to take your attention more to the landscape we find ourselves in today, which of our infrastructure of, let's just call it the oil market, the energy market. And I know you very aptly link them with the physical and paper very tightly. I'm always coming at from the financial infrastructure, but they're so intertwined now. ICE, Platts, pricing, the journalists we're talking about, the consultants we're talking about. I feel like it's been on a 10-year growth trajectory that they've all done phenomenally well.
Yes.
Acquisitions, it's been a really interesting, I can only think about it sometimes from Onyx's perspective, but when I zoom out, I'm like, wow, they really built some powerful things over the last 10 years. But again, like I said at the beginning, there comes a point, doesn't it, when you've evolved to a point where it's almost too big, or there's so many changes coming up. And how much longer can you rise, subscriptions by 100% a year, 300% a year? How much longer can that go on? And then when we talk about AI, the free nature of information, and how clever people can be with it, where do you think we are on the transition? Do you see it becoming, as some people fear, more and more the grip of big corporates and monopolies, or does it break apart? Or where are you seeing it from here on out?
Well, many years ago within Platts, and I disagree with that at the time, because I thought our role was to supply information, price information. It was to become embedded where a little bit of the transaction went to Platts. And there's a little bit of the transaction going to Platts right now. And if that number is reasonable, and that's in the eye of the beholder, then things can carry on for a long time. But if you start pushing it, as you said, 100% per annum, or 50 or 25, whatever it is, but something that is significantly above the cost of inflation, at some point the cost just becomes too high. And these businesses are by their nature monopolistic.
So some would say that is the ultimate success of a business, right?
Yes.
To become a monopoly.
Yes. But some are lend to themselves better to be a monopolistic market than another. For instance, say a car, many countries or companies can build a car, but a dated brand that is embedded in contracts, maybe the custom becomes to use Platts and to trade those things through ICE, and that gives them pricing power. But in the history of humankind, there is a point where the line crosses. And then if the price line crosses, it unbundles all kinds of competition and changes in the marketplace. And I would say, based on the response from the market and things that they say without me trying to dig out, the line seems to be getting very close to that. Because there's a lot of friction. Can we do things differently? can we use AI? I don't think you can use AI, by the way, but people say, can we use AI? Can we use a machine that averages things? People are exploring all kinds of things. That means that pricing point is almost there.
But take that a step further. I mean, we are in the midst of it, right? I mean, next year we come to subscription renewals, or the year after, we're just going to have to take it again. So, I mean, at the end of the day, can you see, I mean, because the opposing argument would be, what's the alternative? And we don't see any viable alternatives right now. And there's apathy as well. You know, there's still a lot of apathy in the industry, whereby they're saying, well, we're making good money, whatever. So maybe this year, having been such a tough year for the industry, is exactly what's needed to shake things up.
Oh yeah, two lines here. In the time I was in APEC, I heard so many discussions about major trading houses not making the kind of money they were making before, right? And when they face that situation, then they need to start looking at where do we make some savings. A friend of mine called me yesterday and said, they're firing a lot of people in Total. And another one told me last night, they're firing a lot in Shell. So things are happening, right? Prices in the mid-60s are not good. Some reconciliation happens somewhere. And that's where opens the market for alternatives. I mean, we're trying to produce, not that we're trying, we're producing good Dubai numbers, good dated Brent numbers, good curve numbers, good everything. So there may be some limited use for this data for people that want to have a lower cost. And we're seeing the uptake by the Jakarta exchange that wants to list these numbers. There's another exchange in Asia that is thinking of listing our Dubai numbers. Those are expressions that come from the marketplace looking already for some alternatives. And that's how the market works. So the time may come, you know.
Okay, so if I added my piece to that, it's the belief that this industry, which people disagree with, or at least think I'm a bit over egging it, but I look at the trajectory that the foreign exchange volumes are still on, by the way. We're talking like 4 quadrillion like notional volumes a year, that kind of stuff. And it's still growing. And if oil picks up its compound annual growth rate and power and electricity, which I think they absolutely will, it will catch up to at least half of that in the next, by 2030. And that's incredible growth. And maybe the real thing here is that when we talk about the names that we're talking about and the infrastructure we're talking about, it's very Western. And you suddenly realize it's like 3 areas in the world. Indonesia is 200 million people.
Yeah.
India is 1 billion, whatever. And we saw what they did with the Jane Street scenario. There was a big court case. You know, the retail Indian volumes were so big, the demand was so strong for equity options that they massively dwarfed the underlying stock volumes, allowing Jane Street to essentially leverage the other way. You know, they could move the stock index up for the options pricing. It's not meant to work that way. Options are meant to be a fraction of the overall volume.
Yeah.
But India demand was so strong at a retail level, it completely shook things up. The demand that's dormant in these enormously populated areas of the world that haven't yet got the kind of financial access that we are so used to, it could completely change anything. And just to finish that off, you know, it wasn't even that long ago when the fuel oil started trading in Chinese exchanges, and the first week it was more volume than the entire Western ICME, whatever, fuel volumes combined. And where was it coming from? Like Chinese dentists and stuff like that in the fuel oil market. So that's kind of to add to your layer. Could it be? Well, yeah, especially if you open up these avenues, right?
Yeah, as it happened, I had a discussion yesterday with an exchange where we were going over the history of what happened in the oil market. And the original exchanges were New York and London, Chicago, if you may, right? And those things happened because there were no price controls. There were free markets in America and in Europe. And that led to their embedment and the growth, because those price signals were free market pure. And Asia had price controls at the retail end, maybe transfer price controls, all kinds of controls. So they became price takers. And every decade, more and more countries in the East go free market. Just straight pass through of whatever you want to charge. There is still a lot of price controls, but the closer you get to a free market there, then they will start asking, so what is the price here? Not what is the price in Chicago or...
No, that's fascinating.
And that is happening now, right?
Yes. I mean, you commentate a lot on global politics as well as obviously the oil markets and energy markets. I would say from what you generally say, the rise of socialism, these kind of things, that actually you wouldn't think that the market's opening up in that way. So they're kind of at odds, those two things.
Oh yeah. I mean, a lot of things are happening where governments following COVID face a lot of debts because they pay people not to work, right? And now they need to pay back, and they're trying to control the markets even further. But let's face it, over the long term, markets are uncontrollable. Markets do what markets do. If there's an inefficiency, somehow or another,
figure it out. Yeah.
They will arbit. They will figure out how to crack that thing. And touching energy is a very difficult, dangerous thing. Because if you, as a government, you control the price, then it becomes your responsibility and people are angry with you. So if you see the history of price controls for energy, over time, governments are like, it's the market. The companies control the price, not us, right? So as it becomes free market, then you need to hedge. You need to have price indicators that are closer to home. And that's the change we have seen in China, right? All that growth we have seen they have so many markets there of anything, of grains, of metals, of so many things. It's incredible. It's because they became, you can call them communist socialists, they're free market really. People sell and buy stuff at market.
Are you kind of saying that there's an inevitability to the free market in Asia and emerging countries then?
Yes.
Okay.
Yes.
Well, I hope you're right, because this is the part of the plan, right? We want to see this massively opened up, and I think beyond that, it could get incredibly interesting, the innovations beyond that. And I think we'll be looking back one day laughing at the legacy infrastructure.
Yes.
Not in a condescending way, they've done a fantastic job, but it isn't set up for global expansion and you know, like the crypto market is now. It's not, this market is not set up for it right now. So I'm excited to see that change and hopefully be a part of that change.
We also had a meeting Monday with a crypto market person who's looking at using oil and tokenize this and that. So all these things are happening.
People are working,
Actually, this week in London has been very exciting for the officials with all these meetings we're having in Zoom or face-to-face, which are an indication that the market wants to move forward.
Yeah.
Right? It doesn't want to be constrained on a working Monday through Friday. It wants to work Monday through Sunday.
Yeah.
It wants to be able to use instruments that are not dependent on the dollar.
Yes.
It wants to go free everywhere. And if we can help, why not, right?
Yeah.
So we have Bitcoin prices. We call it milli Bitcoin, right? Which we have gold. We have all the indicators there that can be used by the market to have an alternative when they're ready.
So let's talk this final bit about, I guess, markets in general as well, but rather than the intricacies, because I'm not actually sure when this is going to be released, but more the general macro themes that say towards the end of the year and next year, like you just mentioned it a bit there, de-dollarization, and the existing OPEC situation. I mean, for a long time you've talked about how the dollar impact with oil, and you kind of, to be honest, as a trader, I kind of tend to ignore it because I think that breakdown of correlation between dollar and oil is kind of long gone. But having said that, I don't think you can ignore inflation-adjusted oil prices for that long. And when you talk about gold price and oil, and it's not actually, you know, there's things like that has actually sold off a hell of a lot, and how OPEC are thinking about it, and how China are now with their SPR game and all this kind of stuff. Do you see essentially, what am I asking you? What do you think, how do you think it's going to look now next year? Are we going into a more institutional, corporate, government-led market in the next year?
No, I don't think so. I think the really big things facing us coming in are the growing debt. Not just in the Western world, it's also in the Asian world, right? Even China has a lot of debt, and Japan has a lot of debt. And how are they going to sort that out. Are they going to increase taxes to a breaking point and slow down the economy like the UK apparently will do? Or are they going to go in money printing? I look at that as an outsider and think it's going to be a mix of the two. And that means that there's going to be more currency left over. And the more currency there is left over is some things are going to reprice upward as there is more currency. And gold is leading the way. Bitcoin is leading the way, right? If you see where Bitcoin was 5 years ago to what is now, if you see gold, it's amazing. Look at silver, amazing, right? But then you have the laggards. And which one is the laggard? Oil. Oil on any currency alternative to the dollar is so cheap. So the point of view I have been making, and we even publish a graph of oil price relative to gold, is so incredibly cheap. So this is going to be a reprice as all this money comes out. The new printed money should come in 2026. I think that's the year of the repricing.
It's going to create unprecedented trading conditions, and I don't even know what to say about that, because typically if you have a bearish view on the economy, you sell oil, but selling oil on a dollar-denominated basis seems a bit crazy as you say that. So maybe we need to be getting involved in multi-currency trading sooner rather than later on an oil basis, and we probably will look at that and maybe offering that, as you said, like your milli Bitcoin settlements and things like that. And maybe that's a natural way in, because I think when we talk about pricing oil not on dollars, the main pushback is always better get settled to a dollar price. That's never going to change. All that's going to happen is, okay, you might trade it in gold, but you're still going to have to look at the dollar price and convert it. And that's always the pushback about why the infrastructure won't change. But that genuinely might change very soon.
The infrastructure is changing beneath our feet. China is creating gold repositories where you can essentially buy or sell things that price out in gold inherently. Is yuan, but is gold supported. In Saudi Arabia, they have one, and I think in Hong Kong, they have another. So things are brewing.
It sounds like a hint about what you're going to be doing for the officials going forward.
I will issue currencies and price of oil in other currencies, and no problem, right? we started that.
Jorge, thanks for doing this, and hopefully we get to do it again at some point.
Appreciate it very much. Thank you.
Cheers. again, it's, you know, the guys I think we have, they want to work together.
Yeah.
And I just obsess about that, because I think otherwise it's going to come out in the wash eventually when someone's selfish. And like you said, like last year we had someone leave who was particularly like that. And it's never going to work with that kind of person around. You can't really work together with that kind of person in the long run. So working with people who you want to work with, biggest bit of advice I'd give to anyone starting a business. So I thought we would refresh our conversation that we had, it's actually 2 years ago, that we actually properly talked about the firm, what we're trying to do, and I guess, the developments of this year in particular. So I guess the leading thing to start with is like, what are the latest things that we've done? So the big developments, I guess,
in the setting up of Axis.
Setting up a new market making division under the Capital Group, consolidating like our services under one brand, Flux. So now we've got that like super clear. Onyx Capital Group is a trading business with market making businesses, 2 businesses across 4 different locations, Dubai, London, Singapore, Zug, and then soon to be New York. And then we've got obviously the service business in Flux that's got the retail offering and this kind of stuff. But I guess starting from the top then, like,
and we've also grown into the power and gas market quite a bit, which is quite a new
exactly. But I guess
for us.
To refresh, people wanting to know what's going on from our point of view and what we're doing. Again, it always starts with liquidity, right? Liquidity providing, that's what we do. That's what we've done for almost 13 years now. So this has been an extension of trying to basically be as big as we can in that space. So I guess this year, like, we don't mind being transparent about it. Axis was about taking traders from competitors, building it so that rather than compete with us in the external market, they're competing within our own brand. And on the back of that, we have a more market share, and we're kind of moving more towards that kind of dominant position, which is obviously great for a business. You see it the same way, right?
But I think, so we've grown our market share significantly by bolting on Axis. And it's nice to have, 2 different setups where they kind of have their own trading views. They're very diverse. We've seen times where, even recently, where, our gasoline book could lose money, but the other gasoline book is making money. So it's not like we are trading the same positions. And again, it's good when the market's going in the right way, when both parties catch that move as well. So it diversifies our risk and exposure.
To emphasize that, like last year in 24, that the opposite happened, right? We had a lot more traders coming in, different backgrounds, and we brought them into the same team. So we're having, like, in this room, trader conversations, and they're actually, what happened was groupthink, right? And we were getting stuck in positions that were too correlated.
And every desk had kind of the same position. When gasoline was coming off, the whole, fuel oil, relative value, every book was long. Whereas when it was rallying, every book was short. So
that's the important distinction with Axis, right? We keep it separate.
Proper Chinese
walls. They do their own thinking, their own management, and everything's different. So in effect, it really is a competitor.
It is a competitor.
And then you get the benefit from that. So for anyone wondering, that's why, right? Because trading can be quite damaging in the sense of, Alf used to call it portfolio heat, right? When too many people have the same reflections, but put in slightly different ways, that can be very damaging.
And I also think, in terms of increasing your market share as a sole desk, when you go to the 30 to 35% level, it kind of saturates. If you go anything above that, you're almost taking the opposite side of the market, which, which I've done sometimes, which, previous employees have done. And then you end up with a position where you can't really get out of, because you're giving the whole market the position, and you're the only one with the opposite position. So there's no outs. So the only way to get out is, you stop out when they're taking profit, if at all, right?
It's a really good point. Becoming that shift from a decent player with decent size to a dominant position from a volume perspective, doing so much of the liquidity providing, as we call it. We've had these new challenges we wouldn't have expected. So I guess what counters that then, if the overall market continues to grow with it, right, then the capacity overall grows.
I think the overall capacity grows. But again, I think the market has also changed significantly to the point where it's kind of over market made now. So, when we were trading propane back in the day, we were one of the pioneers, and you'd always trade with real interest. Whereas now in almost every market, there's 3 to 6 or maybe 3 to 7 people trying to market make. And it's okay in certain markets like fuel oil where it's very big and the volumes are humongous. But in certain markets that are illiquid, you end up just, you're just making two ways. You're trading with each other, and then real participants don't take part. And when real participants want to do something, they can't get it done as well. So sometimes, liquidity is, when there's too many market makers, that's not in the best interest of the market as well.
Yeah,
so you need a dominant
outside of what we do, like the options market making space, right? So generally speaking, options market makers need to be short volatility, right? They need to sell all the options to the world to get on their bets, their insurance and all this kind of stuff. So like the Iran situation this year taught us, right? There was a massive spike and when the tensions were peaking. And we heard, all the options traders lost a hell of a lot of money because they can't not be short. That's how they provide the liquidity.
Yeah.
But as you say, when it's like too many people doing that, then what do they do when the volatility spikes?
It's a crowded trade and it's oversaturated. And again, to add on options as well, that's something new we've done this year, hiring Humayun, who's been a great addition to the team as well.
Yeah, it's trying to, I guess, so increasing the volume of the trades that we do, I guess, is what we would consider market share and going up to about, 30% of all markets.
Yeah, I think 30% is kind of the ideal point, because when you try and force it above that, you kind of end up in an awkward situation. So sometimes you want to sit back. I think that's what I've learned as well is, there's days where you can be 40, 50% of the market. Sometimes everything lines up and everything's perfect and you can just trade everything. But when it's kind of one way, you don't want to be that one person giving all the liquidity because you're just going to get run over, right? Yeah. So I think 30% is kind of the sweet spot as an individual desk. But with the addition of Axis, we've kind of built that quite nicely to that level.
Well, it's getting to like 80+% on some niche contracts, data CFDs, things like that.
Yeah.
But the next piece was, okay, it's all well and good having a lot of volume. How is it working as a unit? And that's something I think has been some evolutions this year, really excited about. So if we talk about New York, right, we've got Billy coming, who is a big distillate and crude trader, but much more on the futures, the block futures. And it's such a core component that, we do, but we're not as dominant in. So him bringing that in creates a kind of a slot in. And so that 1 + 1, Billy plus us doesn't equal 2, equals 3, right? And I'm really excited about that because it's basically, it's the information, it's the centralization, it's the internalization concept you can get, which I think is the next thing. And we talk a bit about that, but then I guess the thing after that is to remember, like what you're talking about, having liquidity constraints with your own trading, getting to a certain size. We've got to remember that that's because we are operating at the very, very forefront of the market. Like we don't get we haven't until now been getting the kind of flow that the banks get, that the basically all these models that provide access get. So by us bringing in this Flux model of Flux markets, giving credit, giving clearing, giving access to retail traders to our market, that is flow that's additional, that wasn't there before. That really helps our game. So that's what I'm trying to say is build really strong liquidity, start to figure out how it works together as a unit, and bolt on additional flow, and that's what we're going for.
You need additional flow. You want different flow, right? You don't want the existing flow in the market. As in the flow in the market is good, but all these avenues open up people who haven't even thought of hedging, or people who haven't even had access to these markets. And retail clients, we have quite a handful, and they're actually starting to make a decent impact now in terms of what we do. I think that's a great addition to the team, and I think it's going to grow and grow and grow. And there's so many untapped markets like Jakarta, Thailand. There's Far East Asia. There's so many people who don't have access to these markets. And again, as you said, everything that comes from these sources will eventually go back to the market, right?
Yeah.
It'll go back to the exchanges, to brokers, to traders, and it just makes the liquidity healthier for the entire market as well.
I think another thing we probably should acknowledge is we have kept the model very tight in previous years, but you get to a certain size position in the market that it's very difficult to operate without being able to handle directional trading.
Yeah.
And I think it's something we've developed over time, and let's be honest, has some pretty shocking periods as well as we've kind of calibrated and navigated these markets. In particular, this has been a very tough year, but last year, second half was very tough as well. But we've learned a lot on that side as well, right? Like we've got Ligier in Singapore, who's pretty much running like a mini fund now, right? He's got like 4 or
his
5
global
guys.
macro book, which trades cryptos and a whole bunch of different things.
But it speaks to, again, trying to not just build something that maybe makes money, it's build something that has benefit to the overall business. So I think Ligier has always been very passionate about directional trading. We did an Inside the Minds episode with him, getting into the grips with like how he's evolved over the last 10 years. And it's very complementary how he looks at markets to what we're doing. He can give you that macro aspect. That you don't feel like you're missing things, right? A big stock market move, a big macro shift. The trick though is really becoming proper like portfolio managers. I think that's been a challenge for me and you, right?
Yeah.
Because we're still quite active trying to figure things out on the ground, but then you have 2 huge portfolios in Onyx Commodities and Axis, and then within them you've got very different trading styles. We used to just be like just curve strip, market make, whatever, like, and kind of boost that a little bit, but now it's gotten so complex that it's just the challenges I'm trying to get at. Like
I think it's been a great experience. I think since our propane blowout in
24.
He's
come up with some names for these. The propane blowout.
It was a Feb or March.
Yeah.
We drew down 40 million in a couple of weeks, which is a big learning experience for us, right? We'd never seen a shock in that way, and we've never had to trade a liquid market to get out of something like that as well.
Yeah, exactly. So, it's not like you can just go, okay, fine, call somewhere up and get out. This is something you have to manage.
That was kind of sleepless months almost. I think when the markets have evolved, when the markets were good and directional, it would have been a lot easier to manage these positions. Whereas this year has been a cluster of news, right? From tariffs to Trump announcing different things every time, Iran, Russia. There's so many macro drivers.
And then mechanisms breaking down, right? Physical traders pushing one thing up versus the other that gets everything out of historical norms. Like it feels like
again, recently as well, propane.
Yeah.
The classic trade was to price CP long, be long FEI spreads, and the Saudis printed quite high, and there's a big shock of this. CP was printed $50 lower. And that caught the whole market because everything was already historically quite cheap. So again, a lot of these markets are changing fundamentally how people trade it. So the whole easy trades aren't there anymore. It's still there in certain markets, but you have to be, risk management is very important as well, I think, in these markets when there's so much uncertainty, when you're at extreme levels on trades. If you look at our cracks at the moment on gasoline, they're at historical winter highs. Again, whether you want to be long it or short it, you've got to be, again, it's stops and risk management, and that's something we've kind of lacked, or I
was going to say, like, we can't say we're like being geniuses in risk management, but I think we, as you say, that any time you have a failure and you learn from it, that gives you a positive expected value over time. But to just very easily say, but your risk management is flawed because you had drawdowns, that's also oversimplifying it, right? Like, you have to look at the lay of the land, what you're trying to do. And one thing that does frustrate me with us versus our competitors and others is, we might have gyrations in our P&L and like what we're trying to do, and bad times, good times, whatever, but we have a plan. So as in, like, if we are going to be directionally short gasoline, we're going to have a macro thesis, we're going to deploy it. It's our prerogative, right? And at the end of the day, like, we're not trying to be a steady 8% a year growth business that we can IPO and go, cheers, like, isn't it so safe? It's our money. And at the end of the day, we do have a plan. We want to be the traders, be on the front foot, switch from a passive trader to very much on the front foot, providing liquidity, but providing the messaging to the market, providing like, very strong stance on how it's going. And that is very, very difficult, especially in a market like this is, like it's been. So the learning, what I'm trying to say is, if we don't learn, that's the bad thing.
But I think from all the experiences, we've had great experiences and we've had a few not so great experiences. So it's kind of learning when you're doing well as well. Could you have done things better? Could you have run things longer? Could you have
and you get people
scaled
say, well,
up?
Why didn't you think about this? Why didn't you think about that? There's a lot of hindsight. It's been very interesting to get third parties in to critique your trading. And what do people do when you're losing money? Why are you losing money? Well, that's losing money, and they emphasize you're losing money. It's like, but it's not really about after the fact, isn't it? What are you going to do? What is really going on under the hood? And then there's these theories about yeah, but are you guys trading to counterflow? Are you doing this? Are you doing that? It's like, look, you try and build this liquidity model and build it to what we have. It's a beast to manage, and that's what we're trying to calibrate right now, basically.
Yeah, and I think we've had a decent year this year, but again, it could have been better. It could have been a lot worse. When in end of Q1, usually Q1s are stellar quarter, and with Trump and all the news that happened, mid Q1, we were down quite a bit as a firm, and then we did really well to recover. So I think we cut the risk, managed it, and then when the market was turning, we added on the risk. And again, we've had a bit of a lull where, again, the propane move and the gasoline move, it's caught us a little bit. But again, it's how you recover and what learnings have you taken from it. And I think all our traders we have now are pretty good traders as well, right? Whether they've made money or drawn down, they're pretty disciplined, they're very communicative.
I think it's an exceptional team. Like if I compare it year on year, I was moments last year very frustrated because I didn't see the method in some of the approaches. But this year you can't say that at all.
I think we have a strong trading team.
But it's also the network, right? Like again, it's all well and good saying, I'm just going to start a firm, hire a bunch of good traders. And that was basically the model when we started and other traders, other competitors. But now it's like, what are you doing about the back end of the curve?
Yeah.
What are you doing about the front? What are you doing about, increasingly digital trading? And that I'm incredibly proud of but the results won't show it this year. I think this is a future thing as Axis builds out and all that kind of stuff.
Yeah, I think this year has been a lot of investing in people, hiring people. We spent the latter part of last year and the first half of this year, going through all our legal disputes and, hiring a great exceptional team. And even when they started out in Dubai, the first couple of months was quite tough for them, right? Because they have been out of the market for 18 months. Things have changed. As I said, there's 10 market makers now quoting 2 ways down the curve. And, the last 2 months, these guys have done exceptionally well and kind of found their own niche and found their own way of trading. I think, we've invested, again, it's key investing in the right people, right? We spent so much time and effort hiring these people for a reason, and we knew, okay, it's not going to be easy from day one. And like, as you said, it's an investment and it's already starting to, yield its rewards 3-4 months in, and it's just going to get better and better and better, I think, as time goes.
And I think the rewards from taking your licks and learning from last year and certain things, and I think I've got to commend the team and they're developing as humans as well, right? We're all personally developing, and I am seeing that with the pretty much the whole trading floor. They're very keen to personally develop, which, to be honest with you, there were some people last year I didn't think that was true. I think they kind of felt like they were the finished article and there was bigger and grander things to do. I think here it's a great compliment to have people come in and go, I can't believe how much nicer it is. There's no politics. We're just cracking on, and I get left alone, but can still interact. It's all these nice things. I think we're starting to get the calibration of the culture, if you like, really, really kind of quite nice. So that's the big win out of this.
Yeah.
But on the flip side, the challenge is, if the markets and conditions have been hard for us, they've been hard for other people. The CEOs of the trade houses recently came out and said it's been really, really tough and hard to predict. But the margins have got higher, and I've made no secret about the costs being extortionate in this market. That also squeezes trading margins, and I think that
we pay 100 million plus in costs, trading costs a year, which is
makes us a
ridiculous.
big customer of the market. But the point is that I would say this year what has changed is it's kind of squeezed out competitors or businesses that actually clearly haven't got a plan for the future, and that's, I wouldn't say I wish bad on them, of course, but as in it's good from my point of view that the model looks sustainable as we are deploying it, whereas others are starting to die out. They haven't really got a plan. Like you say, you might need to take a bit more risk. You might need to do this and that because the liquidity is harder to provide and whatever. But they don't seem to have a plan, some of these other companies, and they're starting to fall away. That's quite interesting.
Yeah, I think we're very well placed in, a lot of us have been doing this for nearly 10 years. We've hired a good group of people. We've been we've kept a lot of our money back in the business as well, right? So we're well capitalized. And again, a lot of people came into this market in 23 thinking, with the whole Russian market and, with all the Russian headlines and what happened during the war, it was a lot easier to make money. Don't get me wrong. It was probably you know,
A lot of funds came in to chase that money. That is what you're
looking
saying,
back,
yeah.
I think we could have made a lot more now thinking.
If
But
it was now,
if it
the
was
develop-
now,
but there will be another time.
yeah,
right?
it'll happen again. But
Yeah.
at that time, our traders traded exceptionally well. They learned a lot, and all the other entrants, such as the funds and the other new market makers, kind of came in at the wrong, well, not the wrong time, but if at all, they kind of added to the problem as well, right?
I agree with that.
Funds came, and you know, we've had a very whippy crude market this year as well. I think finally we've seen a proper break to the downside, but in general, it's been whippy, and there's been stop outs on all angles. So I think we are well placed. I think our competition is dying. You know, you've seen a lot of people pulling out. So I think we are exceptionally well placed with our technology, with our people, with our training
But why do you
program.
think? Why do you think it is? It's just a lack of. Like, I put it down to a lack of plan. But how do you see it?
Yeah, I think, yeah, you need a plan. You need different iterations, and I feel like we've done over the last 8 years all kinds of iterations, from, you know, being purely market making. You know, when you started, every night I used to get a call from Johnny saying, "Oh, Greg's holding 200 CFDs overnight. You know, can you ask him to reduce it?"
Yeah.
To, you know, us now holding thousands and thousands.
yeah,
pricing thousands a day. And, you know, again, the whole propane blowout taught us a lot. You know, on gasoline, we've had great times and some not so great times. Last year, this year, we've learned. So I think we've been active on trying different things, experimenting, you know, with all the technology, all the retail, all the direct trading and relationships. We've kind of got everything. The platform is kind of now perfect almost, right? So I think we're well positioned for the rest of the year and next year. And again, if there's going to be an exceptional market move where
should be well
crude
positioned.
dumps,
Yeah.
you know, to low 50s, or you know, there's some kind of macro event, I think we are so well placed
Yeah.
to maximize that, because, you know, we've learned to be relative value traders, where you can trade when it goes to extremes, and then you've also learned, okay, when it goes to extremes, there could be new extremes
reasons, yeah.
for reasons, and we've kind of got that right and wrong. So I think, you know, looking back, we've kind of been through it all. We've been through easy market conditions to tight market conditions, but we've kind of know when to be active, when not to be active. So I think with our processes and plans in place, I think we are kind of on for a very good ride. And again, having two entities is phenomenal as well, because you almost have two trading houses working under you, which
Yeah.
is great as well.
I think expanding on the future, like obviously I hope what you're saying is correct, but you know, we can't deny as well that the market is evolving. So we've always tried to stay on top of that, but at the same time, you know, we did come into this with people saying your job won't exist, right? And or same thing people say to brokers,
Yeah.
you know, you won't exist, the market evolves, whatever. If anything, it's been proven the opposite, right? I mean, certainly like the Jane Streets of this world, the Citadels, these guys are like mega businesses as market makers. But that aside, we have to acknowledge that, you know, the technology innovations in markets, tokenization, crypto, etc., like how incredibly sophisticated they're getting. It is finally starting to find its way to energy, albeit still like very, very different markets.
Yeah.
We are obviously trying to manage that transition and be on the top of that, but it has been interesting, isn't it? Like, there doesn't seem to be a way in for these kind of more technologically driven market makers as much as they probably would have thought. We know that they've tried and maybe failed, but they'll still be there, they'll still be knocking, right? But again, it's like, how are you feeling about those next 5 years?
Yeah, it's interesting, because I think if you look at markets like Dubai, I think you or Factory were telling me the other day, where like 10 million lots of the front spread traded, and 90% of that was on the screen, right? But I guess Dubai is pretty linked to crude, right? So you can, you know, it's easy for algos to automate and auto-generate markets. Whereas when you look at markets like gasoline, naphtha, you know, if you look at the ice screen now, it's populated with two ways down the curve. I'm not sure who's doing that. But at the same time, it's for 1 KB, or, you know, nothing trades on it. I'd say, you know, 0.001% of daily volumes go through there, if at all. So
Yeah, the screen trading has an element, but it is interesting to see like you say, Dubai's screen is incredibly liquid, but the broker market is still making record volumes. So the OTC is still huge. So
Yeah.
it just helps markets grow, if anything. And we go hiring Billy. Billy's market is futures trading.
Yeah.
But he does block futures with brokers.
Yeah.
Like that's the majority of his market. So it's like, it doesn't seem like they're going to go anywhere. The market will just evolve. It doesn't necessarily mean things stop or start. It's just evolutions, right? But
Yeah.
I think one thing that's been proven is you have to have so much domain knowledge, right? You have to have so much understanding of not just the physical, but the mechanisms of the physical and how it interacts with the benchmark price. And this year has been very hard for people because of the distortion between what's going on in the physical and the benchmark. So imagine that for an algorithm, right? It's just pretty
there's
difficult.
too many niche points, where things work for a while and then it doesn't work, and identifying when it doesn't work is significantly important, and that's where experience or what's happening in the markets. I think the screen helps to grow the market and the volumes, and it gets outside people to look at it. Certain people don't have access to brokers.
But that's what I was trying to lead into Flux, right?
Yeah.
So that's really our thing. So visibility through giving you a platform that has the market numbers, which is straight from our trading floor.
Yeah.
And then our digital trading, we're not just going to throw that out there like to support another platform for the sake of it, right?
Yeah.
But we will do our best to present our liquidity in digital form to our clients because that benefits us, right? I mean, we can start to show people access, show people visibility to get them more engaged with us, get them more engaged in the market. It doesn't necessarily mean that's going to become a hyper liquid screen. It just means it's an extension of our liquidity out to the market, right?
Yeah, it's like it's the same as someone calling us up and asking for a two-way. It's like direct trading, but having it on a screen just makes so much more sense. And if someone can click a button and trade it, that definitely makes sense. And eventually maybe we partner with some venue, so that we have distribution to the entire market from every single user. But again, the time is not right or the partners aren't right. So when that comes about, I think it makes sense. But right now it's a good way to market our services, our liquidity, build relationships with clients, and we started about 3-4 years ago. And
what I really like where it is now is the Flux business can be called one business now and all the things in that business. But really it's like a bit like say New York and Billy joining in Onyx and fitting together. It's a bit like that with Flux. It's like finally now you can see it on basically a screen and a unified service. You can see how it fits into Onyx. It's the way to get access to everything, all our trading basically, our liquidity, which is directly the liquidity in the market. So that's as simple as a message as I can define it. Like Flux is just giving everyone that access directly to that, not just via a bank, via this, via that. It's like, no, just come to Flux and whoever you are in the world, institution or tiny person, you'll get direct access. And I think now that people can visibly see that, even internally, people are starting to get it. Like you say, they're like, shit, this retail flow, like that was actually pretty decent. Like this is cool. You can see it growing. You can see how our model is benefiting people. And hopefully that will just grow and grow and grow and evolve the whole business, really.
Yeah.
So I think what's worth touching on as well is like maybe taking a little bit of a backward step, but the competition again and some of the legal issues we've had and recruitment in general. Like you said, like hedge funds have been out there for the last 3 years hiring basically anyone seemingly half decent.
Yeah.
And then you've got the market making talent, which, from our pursuits, we've kind of seen just how tight this market is, right? There are not that many. And we've pretty much got captive share on those market makers, right? But the money spent to get that, the legal cases we had with Dare, and then the general recruitment out there, it's very, very competitive and tight. So what has been your take on that? Bear in mind, obviously, when we left Mandara 10 years ago, and that was kind of how we felt. We had the world was our oyster a little bit now. Now it's not so much like that. It's like, where are you going to get trained? And these contracts are massively long, and like it's just a very different landscape, isn't it? Like, how do you see that evolving?
I think still the best talent you generate for market making personnel who focus purely on the curve and try to extract value from the curve and position based on what the curve is doing. I still think most of the success we've had comes organically. You hire graduates, you train them, and the only people who've succeeded have been trained under us or the top tier ex-Mandara personnel, right? There were a cohort of 6 to 8 people, and anyone who's done well in the market making industry has trained under those people, whereas people who start their own shops or do different things and try and get into it haven't succeeded in any way or form, right?
It's just become too...
It's too competitive.
Competitive.
It's you need that formula and that structure and to be trained organically, and you need leeway and good management as well, right? We recently lost someone who left propane last year, and he moved somewhere else, and we said, we have a very good nurtured culture. We will guide you. We are okay. We will manage draw. We all in it together. The infrastructure, and we had this whole long conversation, and this person leaves, and exactly what we told him happens, and then he comes back to us and mentions, he's, as a friend, he's like, yeah, this happened, and I was like, yeah, we told you this was going to happen. So
I guess a lot of employers do that, right? They say, it's never good anywhere else. This is the best. But in our case, I guess we put a lot of thought and work behind.
A lot of thought and work. And again, I think it's important, from this whole legal, disputes we've had, retaining staff. We've lost good staff. We've gained some good staff. It's very rare we hire externally market makers from competitions until recently. And I think having stronger contracts is definitely important, because at the end of the day, what's the point in us training people to go and trade elsewhere? On gasoline now, I have 2 or 3, actually every gasoline trader out there has worked under me. And I'm like, I've trained, not every gasoline trader, but trader in the market making angle has been one of our juniors. So why train these people to go and compete with us? You have to be brutal on the contracts, and we've tightened our contracts as well, and it has to be fair as well.
But that's what the legal case taught us. We didn't think these things would hold up. And then it turns out they do, right? A 1-year non-compete can hold up. And then I think the way we've managed that is to be fair, like you say, and say, look, think of this like a footballer's contract, right? You're here for us for an extended period of time, and you get paid for that. It's not like you were going to say you're out in the ether not getting paid, which is kind of where it was going a little bit with other contracts from competitors. So, stick to a period of time where, we get to invest in you, you get to invest in us, and we go from there. It can't be any other way. And this isn't exactly new, right? This is every company that has a growth trajectory starts to eventually think this way, right?
Yeah, I think even, the trading houses, I think it's quite public. Even Trafigura recently increased their non-competes from
3 to 6,
6 months to a year, or 3 months to 6 months. And again, when we had ex-board members, they always mention you have to be careful. Places like, other trading houses are constantly looking for good paper traders, and you guys are training the best. And if you don't have good contracts in place, they're just going to poach your people, which is kind of what happened. But key is
in market makers being integrated into trade houses a little bit. That's becoming a bit of a theme, which 10 years ago they would have laughed, right? You guys don't know what you're doing, like we're the way to get trained. And now it's like exactly as you say, the market is becoming more paper driven, financial market driven. They're definitely starting to see how they integrate that. But there's no substitute for, if you are a market maker, you want to be in a market making shop. It's very difficult to be in like a hedge fund, for example, then suddenly try and make these outsized returns from chopping in and out. And the same thing in a trade house. It's just different models, different mentalities, which leads me to say, you've already mentioned it, but this whole building with people you want to be here and who also want to be here, and getting those right people has been a challenge at times. But I feel now you get a sense, there's a lot of camaraderie, which is, I really, really love that. That's one of my favorite things in life, is to have camaraderie and people you go to war with. And I do feel like we've achieved that. Maybe not finally is the wrong word, but with dips from very big highs, you get to see who people really are. And we've had to let go of people. We've also had people leave us. And it's one of those things where it's very nice to see that what we've got left is people who, you look to your left, look to your right, and they genuinely are here to fight, which I think is the biggest win out of all this. But
I agree. I think we've touch wood, we haven't had anyone who's been with us for a while and grown with us as a family ever leave, right? We've let go of a few people, mutually or non-mutually, but everyone who's kind of been a part of the journey for more than 3-4 years, you know, are still embedded and they've still fought for us, and you know, they put their bodies on the line, right? You know, Jasper is a good example, who, you know, who's taking a bit of time off, and hopefully will be with us in a different role. You know, maybe not trading, but more because again, we've given him a lot, he's given us a lot, and it'll be awesome. We continue the journey together.
Agreed, yeah.
But you know, a lot of these people have put their body on the line and you know, sacrificed a lot for us, and we've sacrificed a lot for them as well. So,
but that's what I mean about coming together when the dust has settled to some extent, or even if it hasn't, and knowing that what people are enjoying is being together. That's a win.
Yeah. So it's a great culture. It's a great, and you're starting to get a few of the next generation of those people coming through as well now. You know, the likes of, you know, Toddies, you know, Albans, kind of the next gen of like loyalists are kind of driving through as well. And it's been a while.
It's very interesting to see that integration of the new generation.
Yeah.
It's never really any different, really. Like they remind me of us when we were like 10 years ago. They all just very hungry, aspiring traders. But again, it's, you know, the guys I think we have, they want to work together.
Yeah.
And I just obsess about that, because I think otherwise it's going to come out in the wash eventually when someone's selfish. And like you said, like last year we had someone leave who was particularly like that. And it's never going to work with that kind of person around. You can't really work together with that kind of person in the long run. So working with people who you want to work with, biggest bit of advice I'd give to anyone starting a business.
Yeah, and I think this year has been a great gelling process. And also we've in terms of desks that haven't worked out, right? We had a power and gas Zug desk which didn't work out.
Yeah.
Whereas we have other power and gas desks that are doing well. You know, we had the systematic book which was run by someone else as well, that didn't work out. And you know, you have to make, and we had cross barrel, you know, we had 3 desks that probably lost, you know, 10 million each in the last year or two, which is, and we've kind of, you have to eventually stop those, you know,
and treat them like investments, failed investments, whatever. Yeah.
Eventually you have to draw the line. And again, why I feel so good is I feel like now everyone we have has great track records. You know, they haven't had a losing year. You know, not ever, but generally they haven't had losing years, steady P&L. So I feel like the team is kind of spot on, and we're constantly looking for new personnel as well. You know, Humayun was a recent addition who's doing quite well. Liege is constantly looking to hire, and Axis has settled in very nicely. And I guess our next one is to see how the US guys settle, right? We have Billy, then we have Scott who trades.
I've been amazed to see the talent out there already. I mean, maybe not surprised, but just really, it's really cool to see how many people are out there when you start opening up your doors. They're like, yeah, you know, we've heard about you guys, you want to get involved. It's exciting. I can't wait to get started.
And I think it'll just open up. You know, there's a lot of people there who want to do EBOB and don't know how to do EBOB, right? It just gives you a gateway into clientele there who might have wanted to do something but didn't do it. So yeah, I think it's quite exciting. That's kind of our next integration project.
And again, I think probably the final thing would be, you know, we've definitely focused on oil always. And we've ridden these waves of pessimism about the industry, low prices, super high prices, renewables, all that kind of thing. But you know, I think we very much take the stance that oil's going to be around for a long time, and particularly the Eastern markets are starting to develop. They're starting to want access to this market, and that's kind of where we're going with the access model, access model, not axis model, and that's going to be really interesting to see. But having said all that, power and gas is actually pretty much where oil was probably 10, 15 years ago. And that's quite exciting for us too, right? And we will be there. We're just taking it steady, right? There's no point just jumping in and becoming
we've got Vinay out there trading some. You know, we have John here, so we've already made in
and the US, right? There's going to be a lot to do, and it will bolt on nicely. And I guess the one thing I want us to keep doing is anytime there's an investment, it's how does it integrate into what we've built, not just another investment that might make money. That's a business of businesses, right, or a fund of funds. I've never really liked that model. It's very it's too siloed. I like the idea of, you know, if we go into power and gas, like we have Stuart out in Zug still, right? He's an excellent gas analyst, and Octavio with him. And you know, that's the right thing to do, is to maintain intelligence, even though you're not too big in power and gas yet, but you want to really understand it as best you can. and you build that way and make sure they're still interacting with the old team. And yes, there's not always going to be synergies, but they've got to feel the concept of what we've built so we can build it steadily in power and gas.
Yeah.
I'm excited to do that.
And we've got Akshay as well, who's now recently moved to set up US Power as well, if I'm not mistaken. So yeah, I think that's gonna see a lot of growth in the next year to 2 years, because oil we've kind of grown and not saturated, but we're pretty good at what we do.
Yeah.
And now we have access who are pretty good at what they do. So they have a bit more growth and they have a few more gaps to fill. Again, we help them with it, but they're a independent entity, but we of course help with hiring and management and strategy as well if they need it. But apart from that, I think for the company, the big push going forward is into the US, power, gas, carbon, that whole space. Certain parts of it is about 20 years before oil as well. So I think that can be very interesting in terms of opportunities. Because again, when we started oil 10, 15 years ago, there weren't many players doing what we were doing. The market was so inefficient. And if you look back 25 years ago when Alf and all the bank traders were doing it, it was, even less efficient, right? So if you can find some of these markets to get into, the opportunities are...
Ride that development wave.
Yeah, abundant, right?
Yeah. Cool. Well, thanks, Oman. We'll be back to do this again, I'm sure, in the next year or something like that.
All right. Thank you.
Hi again, I'm joined with Harinder Sandhu today from the Flux Insight team. We're going to be discussing positioning and their extremes in 2025 using Onyx's proprietary data, Onyx Commodities and Axis's data together. Decent market share there. It sends to the Flux team. They assimilate the data, present it in data form and dashboard form, and that's what Harinder is all about. So what we're going to do is go into some of the contracts where it was pretty interesting, I guess. So what are you going to start with?
So we're in the NAFTA complex looking at the MOPJ crack for the April contract.
Okay.
And to caveat this, to immediately start the conversation, April contract immediately into the danger zone in the mid to late part of February. So you're quite far from expiry, quite far from pricing, and you're seeing conviction in the market, a lot of risk being deployed in the market in mid-Feb.
Yeah, so that's danger zone. I think a lot of people have the open interest, but it's key, right? If you've got the 5-year ceiling and you're above that, clearly something's going on. You know, you're going into all-time highs, and naturally the market goes into all-time highs as the market grows. But this is extreme, right? 300%, 350% more above. There's definitely something going on. But to add to your caveat, this is the MOPJ crack. So the MOPJ crack is being used more and more, but traditionally it's always the European crack and then the East-West in combination. But I think even if you look at the European crack, it was still aggressive open interest. There's clearly a lot of investment in the market in the cracks, basically, during this time period. But yeah.
Exactly. And I think during the time, sort of a bit of market context, a lot of people were looking at, Russian trade houses, the NAFTA flows coming out of there. There were a lot of herdy movements, quite a lot of big swings in the NAFTA complex. So there were a lot of eyes on what was happening in NAFTA. And if we look at the positioning then, so we can see the open interest was high, and we know from our positioning against Onyx that counterparties were selling quite heavily. So that oversaturation was to the sell side. So if we take a look at how the counterparties were actually positioned against us relative to their entry levels, we can see that trade houses especially were building their shorts as time progressed. The entry level was around on a 90-day basis on this chart here. We can see it was around that negative $1 per barrel level, which would have had them in the money at least $2.
So people were generally selling into this rally at the beginning of the year, and they reached fever pitch kind of as we approached to close to positive levels. So the market wasn't liking the rise in NAFTA crack prices and really trying to invest, but decently out the money for quite a while. I mean, $2 out the money is pretty. Oh, sorry, in the money. That was at the end. Sorry,
exactly.
But look, $2 or towards the beginning of their investment. They wore a lot of pain, is what I'm trying to say. But that was a short build up, mostly concentrated. Well, I guess towards the end, but kind of starting its like serious build up, kind of late Feb. Yeah,
exactly. You can see that they're defending their positions quite aggressively. And we do tend to see as prices sort of trend away or they get towards an entry level, that's where market participants like to enter. It's where liquidity is. Yeah. You see that the sellers had the pressure to the downside, and they managed to pressure the prices down into pricing.
So in this case, the refiners were buying, which is, well, it's either unusual because refiners are usually on the sell side of the classic refinery, but I think we categorize refiners here as the people who are also cracking the naphtha into petchems, etc. So them being buy side, it is hedging, but ultimately the majority of the shorts were very much the trade houses, but they were kind of facing off towards the end of Feb against majors, right? So the majors started to come in on the buy side as we approach pricing, which would give you some indication that they think something's happening in the physical one. That's a decent cock off, if you like, right? You're getting trade houses versus majors with the naphtha approaching zero and getting close to pricing. With a heavily invested market, I would be expecting they're going to go to war now. This is going to be a war into pricing. But go on, so continue.
Exactly. So that's the kind of like you said as well before, it wasn't just the MOPJ crack. The MOPJ crack's kind of matured and you started to see more open interest client building in that, but it was across the NAFTA complex with the European crack. I think the open interest on that is 30 million plus barrels. So it's definitely in excess. You see that movement across the board. It underscores the point that all of these contracts are quite heavily connected. So you have the MOPJ crack as the liquidity in the east, the NAFTA crack in Europe, and they're connected with that east-west contract. So there's a lot of interplay between those contracts. It's not as simple as just looking at one at a time. So yeah, that was the kind of the one about the NAFTA crack, the MOPJ crack. Sorry. I think after this, what was particularly interesting, widespread news was the tariff shocks that happened as a consequence of Liberation Day and the following reciprocal tariffs by China. So that was NAFTA, the MOPJ crack, and we saw the trade houses building up those shorts.
And they eventually ultimately won, right?
Exactly.
I mean, that's it. So yeah, we did get the volatility increase you'd expect. And that's all really this can be used to predict. Ultimately, it's will there be a volatility spike or not? Or are we in the middle of volatility and are we getting counter flow, which could suggest a change in market direction or whatever? But ultimately, low volatility or high volatility. And we did get the volatility as promised, but it was towards the downside. So I guess you can coincide that with what you know on the physical and whatever else. But I mean, it was pretty clear as day that actually it did break and the trade houses started to make a decent amount of money. And then if you followed through for the rest of the year, the market's been shorting out for like pretty much the rest of the year after they got that kind of win, if you see what I mean. But anyway, let's move on to the next one.
Yeah, exactly. So the next contract that we're kind of looking into is the propane complex in general, especially following the Liberation Day tariffs and the corresponding reciprocal tariffs that China imposed on the US, and the effects on the propane complex, particularly the LST-FEI, the FEI-CP. So just to start, I mean, we saw massive movements in price. So this is the average entry levels and prices for, I believe this is the C3 FEI contract over the last 90 days from the 16th of April. And you can see this massive move down. I think everyone was well aware of what happened. But we can see that players that had entered, if we look at our counterparties in the C3 FEI contract, you can actually see towards the later part of March, before the announcement of the tariffs, there was a little bit of a liquidation in positions, which I thought was quite interesting because there wasn't really anything fundamental to anything else happening in the market at the time from reading around that was indicative of reasons why we could be seeing selling flow. But we saw that prior to that massacre, the 2nd of April Liberation Day and the 4th of April tariffs from China, there was a selling into the FEI, and then ultimately counterparties came in and bought the dip a little bit lower as they expect prices to rebound. So I think that just being able to see the flow from the counterparties at least starts opening your eyes as to whether there could be something happening in the market in this context.
Yeah, it was a confusing one. This is FEI-CP.
This is just FEI.
Sorry, this is just FEI flat price.
Flat price.
Yeah, either way, it was did move with Brent obviously down, but it was a particularly aggressive move because the FEI is essentially for the physical loading of US barrels. So if you buy it, it's coming from the US, and if it's sanctioned, you can't buy it. So naturally, it's going to tube. So the only buyers who could legitimately buy it as a hedge were the Japanese or Koreans. The Chinese basically couldn't use it as a contract, so it became like a defunct contract. That's all retrospective. At the time, I agree. It was like, I don't know, how do we know if this is real? It didn't make a lot of sense. If anything, I expect FEI to rally because there'd be less oil coming.
Right.
So it was a bit of a weird one, but once we figured out the nuance, that was the answer. So I think I absolutely agree with you. If you don't know, you just got to kind of look at what the market is doing. And the majors who have definitely the information, or at least some certainty, them starting to unwind was, pretty indicative that this was real, if you like, or at least that they've been caught out like everyone else. And then maybe, something to continue to explore from. But as you say, not really, I guess the indications there is that it's not really a spec bubble.
Right.
It's just like there's a physical change and people are hedging it. It's kind of what
Exactly. Yeah. I think what the point we've mentioned in the past that I think underscores this is that you have to always look at positioning, the technical trading reasons, before you start attaching headlines and a narrative to the story. Because you're likely hearing that after the fact, especially with physical, you're likely hearing that well after the fact. Somebody's gone and bought cargoes. They're not going to tell you ahead of time. So that's likely already been priced in. It's crucial to get as much as you can from the positioning, from the open interest, to be able to position yourself, have more market context as prices evolve.
Okay. But going up just to higher up, again, just kind of highlight some of the other features, right? You got the sell-off and you got the vol spike. Sorry, just down.
Right. Yeah.
And you got the vol spike, but it was pretty even, right? Like there was nothing like dramatic in terms of like, as I say, there was no spec bubble, but a volatility spike when you're so balanced, the open interest wasn't particularly high. I think something's going on. I think that's a good way to decipher it. If you'd seen these all hyper short, people all rushing to buy back, or the other way around, super long, rushing to sell with a volatility spike, with high open interest, you kind of know people are getting destroyed and stopping out. It's very much not the case here. But on the flip side, when the tariffs then got removed, it went all the way back up. So it was just choppy volatility. And to be honest, again, from a market functioning and dynamic perspective, this was the beginning of the end for propane this year. It's been an incredibly tough market. You've heard people getting, fired left, right, and center because of the randomness, right? And the tariffs have just really not helped. I mean, the tariffs should have been, volatility that people could make sense of. But when you get into the nuance of contracts, and then you've got CP pricing, which is the Saudi CP, and they can kind of dictate the terms. They changed the methodology throughout the year, and people lost a lot of money on that. What I'm saying is the indication that it's a bad market is when people aren't even in that position either way, yet there's still incredible amounts of volatility and there's clearly something going on. It's like, well, what do I do here? At least if I was long and I lost, I'd want to sell out, stop out, and move on. But when you're like, it's not even like that either way, it's just carnage. Right. You don't know how to position going forward. And I think this was telling its own story of uncertainty is kind of what I'm saying. But let's move on again. Do you have another one?
Absolutely, yeah. So the next, I think, was looking at the NAFTA East-West in July. Okay. So this, again, a little bit of context here. This is around the time that we saw really a ramp up in the Israel-Iran situation. So 13th of June, we had a massive operation by Israel against Iran. I believe it was called Operation Red Wedding, is what it was named after the fact. So that was just, we saw Israel striking Iranian nuclear sites, taking out Iranian personnel. And of course, NAFTA's going to be massively affected by that, but not just NAFTA, the East-West especially.
Because it's Eastern NAFTA ultimately it's impacted because from a physical narrative perspective, the Iranian condensate links quite heavily to NAFTA. So that makes sense as a story. And also, I guess, we kind of coincide, the Russian NAFTA situation kind of ties into it a bit as well. But anyway, the point is that the higher percentage trade in the Iran move was to buy the East-West, or was generally to buy what is actually impacted versus what is not. So that's the East-West because of East versus West. The actual NAFTA cracks, there's randomness there. There's too much going on, but certainly you'd expect East-West should rally here. So I think us seeing throughout the crisis an increase in open interest, I guess that was married with an increase in buying? Or
it was the shorts that were basically massively short, and we just saw them take off all their positions. Got it. So the market was caught really unaware by the situation. Okay. So bit of context, open interest well above danger levels into May, and we saw that decrease in open interest basically as those strikes happened 13th, 14th, 15th of June. Open position, people start closing their positions, and this is really strongly reflected in the counterparty data, where we see this
is what I was saying before. So if you go scroll up. This is the last 7 days of where we're looking at the data, but like it's all net buying in the front and you've got a net short market. It's just clear as day. Like for the overall market positioning, you're very short. And if this last 7 days there's a volatility spike with a lot of buying, it's just scrambling for the exit door. But you could say it was profit taking, but that's why you need to look at the entry prices. And I guess you can see quite clearly at the end, prices rallied way above the entry price of the short. So they would have lost quite a bit there.
Exactly. And I think what's really powerful with this, you see that counterparties are positioned net 4 million barrels short in the East-West.
With Onyx.
With Onyx, exactly, which is, I think, currently around the 40% market share combined with Axis. So quite a powerful portion of the market there.
So it's basically a 10 to 15 million barrel East-West position that the market had, but don't forget, that's executed volume. There's obviously physical behind this and all that kind of stuff. So relatively sizable for an East-West position, I guess.
Right. I think, so perhaps how could you have used this prior to the situation? Well, if you're somebody who, was factoring, either for hedging reasons or you genuinely believe that there could have been escalation, seeing a short East-West to that extent could be a signal in of itself, along with
first thing you do is NAFTA is getting impacted. How is it positioned? How are people? Which one's the vulnerable one? And I think that would have played out quite nicely. But it's also the momentum, right? As you see the prices increase, and you see the market short and buying back, and you see the rate of deterioration of the existing sellers buying back. That's an indication to be buying with it if you can. So that's a pretty good one. We don't want to be hindsight biased too much, right? I would say, generally speaking, if you scroll right to the top, this is why you've put in your alerts part, right? Because it's like, high risk. And we say things are high risk and we try and flag it because when you get to danger zones, when you get, extreme out the money positioning, increase in volatility, this is when you need to start looking. So that's the only thing you can do, right? Just be aware of these things. And if there is over positioning somewhere, if anything changes, you should be aware of those ones that are vulnerable either way. Or it might be the opposite. It might be that there's so much weight behind this position and there's so much physical behind this position that despite a speculative move, the trade houses are willing to stay there. But if they're not and they're starting to deteriorate, they're starting to buy back their position, it's as bullish a signal as you can get in this scenario.
Exactly. Yep. So that was the East-West, a really, really interesting case study there. So I think the next thing we're looking forward as to what's particularly interesting in the market right now. Greg mentioned it perfectly. We have this alert system now in the COT dashboard, which flags those contracts that have certain characteristics that might lend them to having aggressive moves or ones of note, effectively. So we see again, it's the East-West that's the contract of interest. Open interest is in the danger zone, and it's increased 21% over the past 5 days. So a large move there. With Onyx's data, you now know that move has been to the sell side, saturated to the sell side. So recent flow out to the sell side, with the longs out of the money and the shorts in the money. And we have the ability to zoom into that contract itself.
Very interesting.
So here we have it. So this is the again the NAPTHA East-West November contract. Open interest.
It's a very similar scenario.
It is exactly saturated to the short. So we're seeing that. A lot of selling coming in recently. Volatility is high.
And people are doubling down though.
That's exactly it. And we see now shorts are slightly out of the money. So whether they come in to defend their positions or we see these shorts stop out, that remains to be seen. Last I checked the NAFTA East-West price, we're slightly above. We're kind of like in the $36, $37 per metric ton. So we are drifting a little higher. I think this is a really, really interesting contract to watch out for.
But again, we're in the midst of a new event, which is the Russia event, right? So with the SDN sanctions, yeah, Russia are big suppliers of heavy naphtha in particular. And of course, that it's actually pretty damn similar, to be honest with you. So the difference with the two cases is they're not buying back, they're selling more.
Right.
So I think, I don't know, that's something to keep an eye on. But if you start to see that deterioration and the 7-day start to move aggressively more to the buy side, you've already got a spike in vol. You've already got the market out the money on the short side.
Right.
This could suggest either they really go in and protect it as NOV starts to price, which is only a week away, or it's going to be seriously damaging. So either way, probably one to, as a paper trader, probably stay out of.
Right.
But at the same time, this will have ramifications across the curve. And I think just to add to that, it's probably don't have enough time to go into it right now, but on the NAPTHA cracks as well, there's been a big bear story, big selling for a long time. So it doesn't surprise me at all that the market's oversaturated short. And when the market's oversaturated short, an event like this can really, really hurt people. So, so you need to be aware of it. So that's good. Nice little summary of the alerts there, and you can filter that by product or whatever.
Exactly.
Or you filter it for all products initially.
Yeah. So initially we take a look at across the complexes, but if you're particularly interested in, let's say we looked at naphtha, let's say we're interested in gasoline, well, we pick out the contracts that in the gasoline complex. And I think the powerful thing about this is you can see everything connected. So instead of seeing a contract in isolation, you can see how the flows are being distributed across the complex. So in this case, yeah, EBOB cracks are the ones that are particularly high. So yeah, that's the alert system for COT. The next thing I actually wanted to flag, again, it's part of the positioning analysis that we do, is actually it's flat price. So with our CTA dashboard and CTA positioning modeling, we can try to infer how CTAs, those trend following algorithms are positioned and where they might go. So in our case, I think this is especially interesting because we have this positioning index, which takes those raw positioning values, normalizes them, and then we can run tests to see how positioning would have performed historically. And even right now, we've seen this flat price rally from around $61 per barrel up to, I think, 66 last I checked, in the front month Brent futures. Well, with our positioning index, we've done tests to look at when CTA positions are overextended and underpositioned. And when we're below a score of -45 on our index, which is effectively near the bottom that we've seen the index position in the previous 3 years, you tend to get this reversal up. We've done the back test and we found that 64% of the time we get that reversal up. Even more interesting is if we filter down to Brent specifically. So this is a back test across the futures. With Brent, it's 77% of the time. It's even more poignant. And just to underscore that point, when we did cross into that -45 territory, which was the 17th of October, had you bought, of course, we don't want to say, be too confident in hindsight.
Well, obviously you can't predict the sanctions, but it's primed that way.
It's primed. So that it comes in with the flow. So the momentum, as soon as you get the move to the upside, the CTAs are perfectly positioned to pile in. In this case, they're so underpositioned, it's just driving them up. And you can see in our estimates, we're -42,000 lots short in ICE Brent. So there's a lot of room to the upside before we reach neutrality, which could provide further support to prices. The other interesting point that one of our analysts, associates Martha, mentioned is that $65 per barrel is a really important resistance level. And as you get above that, algos tend to pile in, especially if there's momentum to the upside. So that will be a really important one to watch. In the coming days.
Great. Does that summarize it all?
Yeah.
Well, thank you very much, Harinder. And that kind of sets the overview of the year and like some like interesting ones. But I think this is going to be great to use as a foundation to do more episodes of what's going on right now on the context of positioning. So look forward to that. And thanks again. See you soon.
Hello and welcome to another episode of the European Market on Close. Today in the North Sea there was nothing going on. Basically both sides went completely extinct. No bids, no offers, nothing, which should leave our physical differential roughly unchanged. As we can see here on our chart, we've come pretty significantly down, around the 50-cent mark. Yesterday it was assessed at 14 cents according to our team's assessment. So we should see this physical differential stay relatively stable around this area, as pretty much nothing was going on. Now, if we were to dive quickly into the futures market and see what is going on in flat price action, we're trading pretty low. Right now we're below 63, trying to hold around the $63 level, but it's been pretty weak. As we can see here on the chart, we're at our weakest we've been in a while. November we're trading around on the upper 65 range. Now we're already down in the 63 level, and as we can see, we basically are trying to find what's the new floor. Over today in the morning, we've seen this steady downtrend. There was we tried to have a hold in the 64 range, but we're trading again around the 63 barrel, even below that. And the same has applied to spreads. As we can see here in the prompt spread, the market is there's again fears. Was the super glut? Was the crude on sea? What's going on with that story? And the future strength seems relatively weak. 25 cents for the prompt spread. This is the lowest we've seen it in almost a month or over that. And we are testing for new lows constantly. We even broke at the low 20-cent range, around 21, 22 cents. So it's pretty weak. And even on the third spread, the March-April one, we're even testing contango right now. As we can see, we're trading around 2 cents. We even traded at parity. So contango is near us. The more deferred spreads are already in contango. So the weakness is here, folks. But if we were to look at the physical market, DFLs were up slightly, although, and CFDs significantly stronger in the afternoon compared to yesterday. We can see here every CFD is pretty much up. In the morning, remember, we had bull week 1, week 2, week 3. All of them were deeply negative. Right now, we're around 10 cents, 7 cents in the November weeks and the first December week. And after that, we are around 40 cents. So the question is whether this market has legs to go down, or we've pretty much found this floor right now. Obviously, we're going to cover any more details in the officials posts in our Flux LinkedIn page and our Flux freemium in the next episodes. Thank you very much, and see you tomorrow.
do.